Recording in progress.
Good morning, honorable members, stakeholders present. Can you please flag the agenda on the screen?
Morning, Chair, can you say it?
Yes, thank you. Honorable members, representatives from National Treasury and SARS, our stakeholders and guests, good morning and welcome to this important engagement session. Today marks a critical step in our consultative process regarding the fiscal framework and revenue proposal. As we transition from receiving public submissions to hearing detailed response from National Treasury and SARS. In the previous hearing, we have attentively considered the concerns, recommendations, and expert insights shared by stakeholders, both in written submissions and oral presentation. Honorable members and stakeholders, your contribution have been invaluable in shaping a more inclusive and responsive fiscal policy. Today, National Treasury and SARS will respond to the key issues raised, providing clarity on policy considerations, addressing concerns, and outlining potential adjustments as needed. Following their presentation, stakeholders will have the opportunity to engage further, seek clarity, and deepen the dialogue. As per the agenda, honorable members, 3 more minutes will be given to each participant to engage a National Treasury and SARS responses. I think, honorable members, as per the agenda, I just want to check with maybe also to welcome Dr. Masangali, my co-chair, our honorable members in the platform. Can I request the Secretariat to assist with the apologies?
Morning once again, Chair and members, stakeholders, officials. We have 2 apologies from Honorable Ryder and Honorable Lihwase, Chair. Thank you.
Honorable Ryder and Honorable Lihwase. Okay.
Good morning, chairs and everybody present. No apologies from the Standing Committee on Finance, but there is an apology from DM Sarupin, who is unable to attend today. Thank you.
Okay. Mark Beck.
Thank you, Chair. My colleague Wendy Alexander has asked me to tender her apologies for today's meeting.
Okay. Thanks very much, Mr. Beck. By so saying, honorable members and colleagues and guests, can I allow National Treasury and SARS, National Treasury first, to respond to the submission?
Morning, Chair, honorable members. My name is Wipuso Modise. I am the head of economic policy and international cooperation at the National
Chair.
Treasury.
Hello, Chair.
Honorable Mote.
Morning, Chair. Sorry, my hand was up before Mebu Ipuso. Okay. Chair, I'm just going to request that as the National Treasury is doing the presentation, can they also indicate when is the Gazette going to come? Because we've been following up with the Office of the Minister. We were told that there's a letter, there's a memo, but the Gazette has not yet been approved. So can we get an indication from them as they're doing the presentation as to when can we expect the Gazette to be issued? Thank you. The notice to be issued on the Gazette. Thank you.
Okay. Maybe Puso.
Thank you, Chair, and the request has been noted. I will request that we deal with the request as part of our first round of responses to Q&A. So we've noted it and we will deal with it at that point.
Okay.
With your permission, Chair, honorable members of society who have contributed to these engagements on the parliamentary hearings, with your permission, we will flight the presentation. I will ask my colleague, Keting Osidlamene, to please flight the presentation so we can speak to it accordingly. So if you could please give us a moment to load the presentation and I will be speaking us through it. In the interim, just to give a sense of the sequence of events, I will provide an opening to the presentation. I will then also be joined by a few of my colleagues who head different portfolios across the National Treasury. They will introduce themselves as they come in, but to give a sense to the honorable members, chairs, and stakeholders on the call, it will be myself, it will be Christopher Axelson, the head of tax and financial sector policy. It will be Mr. Marumo Mage, the acting head of the budget office. And then it will be Mr. Ravesh Rajlal, the acting head of assets and liabilities management. I will then conclude. If you could please go to the next slide, Keta. Firstly, to acknowledge and thank all of the stakeholders for your engagement in the budget process. We've received several submissions from you, and they have informed our responses today. I think that they speak to the vibrancy of our democracy and engagement in the budget process, which is necessary and important to ensure that our budget is credible and meets the objectives that we set ourselves. Next slide, please, Keta. In engaging with the budget documentation, a few key themes were brought to our attention that we wanted to elevate in the context of this response. The first is in relation to credibility, and in reflecting on this, a few key elements have informed our thinking around the budget and how it has been presented, as well as the priorities and trade-offs that were made in coming to the budget that has been presented. The first, from a credibility perspective, is that we have considered that the framework is credible by ensuring that we have a succession of primary surpluses which are sufficient to ensure that debt does in fact stabilize. We've also, while doing this, managed to ensure that the fiscal framework prioritizes the social wage without overcommitting future generations, speaking to the sustainability of the fiscal framework. The framework that we're presenting also navigates complex trade-offs in a transparent and accountable manner, which is necessary and important for the credibility of the fiscal framework and the macro fiscal planning process in general. From a transparency perspective, we have seen over the past several years that the government and the government's budget, as presented by the National Treasury, has a long history of scoring well on open and transparency indices. One of them being the Open Budget Index. We're currently ranked 4th out of 120 countries surveyed. In addition, the IMF's fiscal transparency evaluations have shown that our budget is in fact built on trust and accountability from a transparency perspective. Despite this, we are still looking for areas of improvement, as this is necessary and important for the fiscal framework. And one of the areas in which we are engaging and looking to improve is on public participation and strengthening these levers, which would improve our engagement on the budget. We have done significant work in this regard and continue to do so to ensure that we are able to improve and ensure that our budget continues to be a transparent one. In addition to this, what we've seen in the crafting of the budget process or the iterations of the budget process over the course of this year is that budget debates have shown that there are different views reflecting the difficult trade-offs that are associated with the budget process. And while this discourse has at times been polarized or challenging, it does reflect the strength of our democracy and is also reflected in the richness of the engagement from the different stakeholders in the budget, which we saw in the first slide that was flighted. In this context, the government remains committed to listening to all South Africans, and this budget reflects some of the voices and some of the considerations that have been put forward as part of these process. Our budget this year reflects the previous iterations of our stakeholder engagement and shows that while we take into consideration the different iterations and proposals, we do them in the context of the credibility and the transparency of the fiscal framework. Next slide, please, Keta. I'll now spend some time reflecting on the economic strategy and how the fiscal strategy is a component of the economic strategy. We have proposed in the past several iterations of the budget that, in our view, there are four critical components of a credible economic strategy for South Africa in light of the fact that we have a structural growth problem, which is characterized by low potential growth led by falling total factor productivity. And as a result, we need to address the structural nature of the growth problem by four key things or through four key pillars. The first is maintaining macroeconomic stability, which promotes low and stable inflation. It lowers interest rates while enhancing our ability to withstand external shocks, like we have seen over the past several years, most notably through the COVID pandemic. And also which are currently affecting our medium-term outlook, which I will speak to over the next few slides. This creates a conducive environment for investment, savings, and job creation, all of which have implications not only for near-term growth, but also for the potential at which our economy can grow. The second element that we think is critical for addressing our growth prospects is implementing structural reforms, particularly network industries that support economic activity. This helps us to increase efficiency and promote a competitive economy through improved confidence, investment, while addressing some of the core supply side constraints to job creation and employment. In addition, we think this needs to be complemented by building state capability in which we have a credible, capable state that is able to identify and solve problems, with a focus of delivery of services in core function, enhancing accountability, all of which create and support the economic services required to support economic activity more generally and subsequently put us on a stronger and more robust growth trajectory. The final is the reforms required in investment through growth enhancing public infrastructure, which we have spent some time reflecting on in the budget documentation. But again, just to reiterate, this is critically important because it supports economic activity through mechanisms like industrial growth. It promotes innovation, attracts foreign investment, and improves infrastructure, which also improves productivity with positive implications, not just for the rate at which we grow now, but also for the rate at which the economy can grow. In the context of these four elements of the growth strategy, the 2025 budget and fiscal framework reflects our approach to macroeconomic stability in particular, while giving expression to the other three pillars, which is necessary and important for the growth strategy. The fiscal strategy that we are presenting stabilizes debt as a percentage of GDP and achieves a primary surplus, expand infrastructure investment, and supports the social wage. Again, reflecting on the trade-offs that I had spoken to in the previous slides. Next slide, please, Keta. In the next few slides, I'll be speaking to some of the comments that we received in relation to the macroeconomic projections and outlook. There were questions related to the transparency of the framework or the macroeconomic projections, particularly in relation to the assumptions that underpin them. Just to remind honorable members, chairs, and stakeholders that we publish these assumptions both by way of the global economic context, which gives us a sense of external demand and the supportiveness of the external environment to the growth outlook, but as well as key variables that inform how we think about economic performance and that are supportive of inform the growth outlook. We present these both in Table 1 of the overview table in the current documentation published. And what is different this time and may have resulted in some of the questions regarding the assumptions being published. We generally publish them in Chapter 2 in the budget review, but in this instance also published them in Table 2.3 of the annexes to give a sense of some of the key drivers that inform the macroeconomic outlook. Things that are worth noting here is that the global outlook has deteriorated since the time of the March budget, with implications for the overall growth trajectory, which I will speak to in the next slide. In addition to which, this has had implications for global demand, as well as export commodity prices, with the exception of gold, which has rallied somewhat in the face of global uncertainty. In addition, something that we are particularly concerned about because of its relationship with the cost of capital and subsequently the cost of debt for the fiscus or the sovereign, as well as the economy more generally, given the centrality of the cost of sovereign debt for long-term debt setting in the economy, or the price of debt in the economy for long-term debt. We're particularly concerned that the sovereign risk premium has been revised slightly upwards to 3.2%, a 3.2% average in 2025, which reflects heightened geopolitical and political uncertainty, both globally and within South Africa to some extent. If you could please go to the next slide, Keta. In this slide, we are presenting the growth outlook. We've spoken to this both in the previous presentations. It is available online as well as in the budget documentation. So I won't go through this line by line, but I will speak to the important elements of the growth outlook, which have implications for the fiscal envelope through the tax basis and subsequently the revenues that we can collect, as well as the denominator for many key fiscal variables being nominal GDP. We've now revised our growth estimate to 1.4% in 2025, taking into consideration, as I'd mentioned before, changes in the global outlook, but also incorporating the fourth quarter GDP print that we had indicated at the time of the March budget. We didn't have adequate data to inform the updating of the macroeconomic framework to reflect this. So now the framework reflects this new data point, as well as the developments that have occurred both in the global and domestic economy. We now estimate GDP growth to be 1.4% in 2025, reaching 1.8% in 2027. These are significant downward revisions with implications for nominal GDP and subsequently the resources available for fiscal planning. Looking at nominal GDP, we are now estimating nominal GDP at 7.7 trillion rand in 2025 and reaching 8.761 trillion rand by 2027, which has implications for, nominal GDP and fiscal resources available. In light of this growth outlook, which is quite pedestrian in relation to the pressures and trade-offs that we need to think about from a fiscal planning perspective, and the subsequent impact it has on the amount of resources available for fiscal planning, it's clear to us that we need to be implementing those 4 pillars of the growth strategy to boost our growth prospects and to get us to a point where we have more resources available in the fiscal envelope for planning and addressing the socioeconomic priorities that are clear from a societal perspective. If you could please go to the next slide, Keta. Thank you. As part of this, the second pillar that I had spoken to in the framing slide of this presentation under the economic outlook was the implementation of structural reforms. We have, in past iterations of the budget documentation, indicated the premise under which we had adopted structural reforms as part of our thinking of the growth strategy. We'd released the Towards a Growth Strategy document in 2019. Significant work has been done in modeling the potential impact of Operation Vulindlela, both by the Treasury through our different scenarios processes that have come or that have coupled our baselines across different iterations of the budget review and MTBPS. But one of the questions that we were asked this time was, in light of this initial thinking around the importance of structural reforms, what has Operation Vulindlela actually accomplished in its first phase? Fortunately, we were able to close out the first phase of Operation Vulindlela and now have some sense of the economic traction that it has been able to gain, and has also given us a clear sense of the impetus and the importance of implementing structural reforms as part of our growth strategy. To give some color to this, we know that 94% of the reforms that were identified or reform the actions identified in the first phase were completed or progressing well by the time of the closure of the first phase. Approximately 500 billion rand of new investment had been unlocked through reforms, many of those in the energy space, which was one of the most significant constraints to economic activity over the past several years. To give a little bit more color to this, as at the time of the closing out of Operation Vulindlela Phase 1, 22,500 megawatts odd of private sector investment in renewable energy projects had comprised the pipeline available in relation to renewable energy. We also saw significant improvements in the cost of data. For example, there was a reduction, 51% reduction in the cost of 1.5 gigabyte data bundle as a result of the reform actions in the telecommunications space, which has implications not only for the cost and ease of doing business, but also for the cost of living of South Africans. A final notable recommendation, notable achievement in this regard was the number of days that was required to obtain a water use license. Oftentimes a significant component of starting a business or economic activity in South Africa had been reduced significantly from 300 days to about 90 days, which is a significant improvement and tangible economic progress. In light of this, it is clear that there is clear benefit from an economic perspective to implementing reforms in the context of these 4 pillars of the strategy. There is the Operation Vulindlela Phase 1 review is available at the hyperlink available on the slide to give more color and more detail to some of these accomplishments. But if you could please go to the next slide, Keta. In light of what we've seen from an economic traction perspective, it is clear that we're on the right track from a reforms perspective in terms of what it can do for growth, not just in the medium term, but also in the long run. And subsequently, this traction has given impetus to the second phase of Operation Vulindlela Phase 2, which was launched earlier this year. And some of the priority areas of the second phase look at following through on existing reforms in key network industries, namely electricity, logistics, water infrastructure, and visa reform, which are continued priorities from the first phase, but it also expands into new reform areas, including intercities to ensure dynamic integrated cities, which enable economic activity, harnessing digital public infrastructure as a driver of growth and inclusion, which also speaks to the third pillar of our growth strategy, and building a more capable state, and strengthening local government to improve the delivery of basic services. These elements together could have significant and positive implications for growth. As I mentioned, honorable members, we gave some of this in the annexure, but also have presented this in different iterations of the budget documentation along as part of our scenarios analysis. And we will continue to be doing this kind of work from a quantification exercise as part of the Operation Vulindlela progress. I will leave it here and hand over to Chris to speak to some of the considerations from a tax policy perspective. Thank you.
Thank you. Good morning, honourable chairs. Good morning, honourable members. I'll take you through the tax section. On the first point to note is the overall revenue figures. They are about 61.9 billion down compared to the March 2025 budget. The one point to note is they are improved upon the previous MTBPS forecast. If you look at the table here, you can see that we do have higher revenues across the term. The buoyancies are also higher, but for 25, 26, and 26, 27, that is mainly due to the increases in tax revenue from additional tax policy measures. There were no measures in the 2024 MTBPS, but they are included here. But there is that big reduction from the March budget, mainly due to revisions lower to economic growth and the tax bases. as well as smaller tax revenue increases given the change in the tax policy packages. We go to the next slide. Just a quick overview on what was proposed in the May 2025 budget. The VAT rate increases over the next 2 years were withdrawn, but the zero rating proposals alongside the VAT rate increases were also withdrawn. We still required additional revenue to accommodate the increase in expenditure. There's a very large increase in expenditure compared to the 2024 NTBPS. That increase was reduced slightly, but it still required a large amount of additional revenue to make sure that we have a fiscally sustainable trajectory on our debt and debt service costs. Because of that, this May 2025 budget does include 18 billion in additional revenue for 25-26, and then has 1 billion in tax relief in 2026-27, but does also include an unspecified tax policy increase of around 20 billion for the 2026 budget. So the main measures to raise the revenue this year were that there was no change to the personal income tax brackets and rebates. There was an inflationary increase in the general fuel levy, whereas in the March budget, there was no increase at all. There were above inflation increases in excise duties on alcohol and tobacco. Those are the same as what they were announced in March. And the diesel refund relief remains the same as the previous March budget. The 20 billion in unspecified revenue, we will look at additional proposals for that, including the alternative revenue proposals that were put forward. However, we have provided a larger additional allocation to SARS to improve efficiencies and try and reduce debts. Their revenues, the additional revenue that they could get from that project is assumed to be between 20 to 50 billion. If that is achievable, and we will be publishing monthly data to assess that, and the public can also assess that, then we can revisit both the revenue estimates at the NTBPS as well as whether we need to still raise that additional 20 billion in revenue in the 2026 budget. Next slide. So just in terms of how we go about thinking about what tax increases to change, in this budget, we needed to raise revenue to fund the additional expenditure amounts, but how do you go about raising that revenue and what do we think about? So the first part is, will it actually raise that revenue? So if you make a change to the tax rates or the tax system, will it raise that revenue? Now, what we have seen was previously we increased the rates of personal income tax, including the top rate, and we didn't get as much revenue as we thought we would get. So it wasn't a very good revenue raising mechanism to change those rates. Corporate income tax, similarly, is very cyclical and volatile. We had big increases in corporate income tax after the COVID crisis, where there was a mini commodity boom, but then it fell away almost as quickly and dropped quite dramatically after that. So it's very volatile and it damages growth. CIT corporate income tax increases are the most damaging to growth. And if you reduce growth, it reduces the tax bases of all other tax bases as well. So it's not as effective. We're also very worried about equity. The main point to make here is that the overall tax system is highly progressive. We have very steep increases in marginal personal income tax rates on our personal income tax system. We have a lot of other taxes that target wealthier households. Indirect taxes are not as progressive, but it's important to diversify the tax base, that you have a variety of different tax instruments so that you can draw money from many different sources with lower rates across all of them, so that you are least detrimental, have the least detrimental impact on growth. A few commentators did talk about the fact we needed a very broad tax base. And to have a broad tax base, you need to tax both direct taxes, which are highly progressive in South Africa, as well as indirect taxes, which are less progressive. Horizontal equity is also very important. We try and tax each individual the same. We try and tax the products the same. And there are quite a few considerations about that. Efficiency is the other very important one. We're in a low growth environment. We shouldn't make tax policy changes that undermine the potential for growth. So we need to look very carefully at what instruments are the most distortive and will have the worst impact on growth. The research shows there that VAT is the most efficient, which was part of the reason why it was originally suggested. And other taxes are not as efficient. And as I mentioned previously, corporate income taxes are the worst for growth. Simplicity, we also check whether it is easy to do or not. And a lot of those taxes, especially in some of the proposals that are put forward by stakeholders, the simplicity is an important consideration. Very complex taxes are difficult to do, and they're also very difficult to raise taxes immediately. We have a lot of instruments at our disposal that we can change within a month or two. But if you have a brand new type of tax, and that one that is very complex, it will take quite a while to do the legislation as well as to implement. So it would be more of a medium-term measure to consider. Next slide. So did our tax policy strategy change? It did. Over the last 5 years, we've been trying to avoid tax increases as far as possible since 2020. So we've been staying away from bracket creep or fiscal drag on the personal income tax side. We haven't been increasing the fuel levy. We've tried to avoid those tax increases as far as possible for the economy to recover, and because of the cost of living crisis. We did say in the MTBPS in 2020-24 that if we were to increase permanent expenditure, we would need permanent revenue sources to do so, which is why this budget has adjusted to increase revenue on a permanent basis. As I mentioned, compared to the March budget, we've kept the PIT brackets, we've reversed VAT. We also reversed the zero ratings and not adjusting fuel levy for inflation, because those were mechanisms to reduce the impact of the VAT increase. And with the VAT increase no longer taking place, we didn't need to include those measures to provide support. We do look at the trade-offs that take place. And in an environment where you need to raise revenue, those trade-offs will be apparent. We will have to raise revenue somewhere in order to fund this additional expenditure. And we've had a lot of divergent views from the commentators in the public hearings. Some of the commentators said that we shouldn't be having this conversation at all because spending reform should be reinstated so that there aren't increases in additional expenditure, which would then mean there is no need for an increase in tax. Other commentators have been very critical of VAT and fuel and the no PIT adjustments. Some commentators are worried about the additional allocations that will to SARS and the fact that they need to raise 20 to 50 billion, and they're worried about the impact on taxpayers. There are proposals about illicit financial flows and closing loopholes. There are some commentators stated that we should avoid indirect taxes altogether and only go with direct taxes. And some commentators prefer no increases at all and rather broadening tax bases. If we go to the next slide. So on some of these comments in specifics, there was a comment that removing the fuel levy is regressive, and it's very similar to a VAT increase. In a previous session, I did say the quantum is very, very different. The VAT increase over 3 years would have raised about 75 billion. This is closer, the increasing the fuel levy by inflation is closer to around 12 billion compared to if there was no change to the fuel levy. But the main point that we want to emphasize here is that you need to look at the system overall. And overall, the tax system is highly progressive. We can't look at tax instruments in isolation. Otherwise, there would be no fuel levies or VAT at all. But we need a diversified income tax base, diversified tax base. And the overall system needs to be very progressive. And there are quite a few fiscal incident studies that have been done by the World Bank and others, which compares our tax systems to other countries, and we are very progressive. This fuel levy hasn't been increased for 3 budgets now. Part of that was due to the very high oil price and petrol prices and diesel prices. Those have been coming down lately. The recent non-adjustment in the March budget was to provide relief for VAT. And because we haven't been doing that, we are going to increase the fuel levy by inflation. There was a comment there just about JAFECRA, quite a few people made. The one point to note is that if you have a JAFECRA drawdown, you can't use that for permanent expenditure. And as our NTBPS statement said, if we needed permanent additional expenditure, we need permanent revenue sources that you can get in year after year. There were a number of alternative revenue proposals put forward. These were also raised after the March budget. We did try to respond to those in previous response documents and presentations. We have a long list of slides at the end of this presentation, which also includes our responses to a lot of those. A lot of them are very good and very interesting proposals, which we're going to have to consider very carefully, and we will consider and hopefully have more of a consultative process before the next budget. A big part of those will need to be considered for the additional 20 billion in unspecified tax increases for the 2026 budget. If SARS comes through with the additional revenue, we won't need to do that, so we wouldn't need to raise additional revenue, but we will still go through those alternative revenue proposals and consider them and try and provide some advice and analysis to see whether they are reasonable prospects to put forward. We'd also just like to thank all the commentators. There are a lot of proposals. There's a lot of different perspectives, which really does help us, as well as getting new ideas on potential revenue raising mechanisms, which is highly useful. Thank you. Next slide. So just on the general fuel levy, a couple of points we'd like to make is that this isn't a rate. So it's not like a value-added tax rate, which is 15%, and if prices go up, it will stay at 15%. This is a specific tax. It's a cents per litre. So these types of specific taxes, which is the same for excise duties, they need to be adjusted by inflation. Otherwise, the real value of that tax will go down over time. If you look at the percentage of fuel levies as a percentage of the price, they were hovering around 30 to 40% of the price before 2020. Then there was a very big increase in the price, and that percentage dropped down to around 20 and has been slightly going up. But if you don't make those adjustments on an inflation-related basis, the real value is just going to go down over time, which is why we assume that inflation-related changes will be implemented each year. And it's the same on the personal income tax side. We assume that personal income tax brackets will go up by inflation, which is why that if we do put them up by inflation, we don't raise any revenue. Whereas in this case, by not adjusting for inflation, we recognize that on the personal income tax side, that means additional revenue that everybody needs to pay. And in this budget, the vast majority of the tax revenue increase is all on the personal income tax side. Around 16.7 billion of the 18 billion in increases is all on personal income tax. If we didn't adjust the fuel levy, we would have lost about 3.5 billion. This would have directly impacted the expenditure that we would have been able to increase in this budget. So it's important to look at this type of tax, this fuel levy, in a different way to rate changes. Because it is specific, we do need to make inflation-related adjustments. Otherwise, the value will just continue to go down from year to year to year. If we go to the next slide. Another point is that it is the fourth largest revenue instrument in South Africa, but also it is zero rated for VAT purposes. A lot of other countries don't zero rate fuels, but we do zero rate fuels. There's a slide in the end of the annexure which compares us to other countries. We are higher than oil producing countries. Oil producing countries have much lower taxes than us on fuels, but we are much lower than other developed economies. And that slide is quite interesting. A lot of the other countries have VAT on their fuel, which even when the price goes up, the average, the percentage applied to that fuel price will stay the same. Prices have been going down. We do have other objectives with the fuel levy. There are environmental objectives, there are congestion objectives, and those also do need to be considered in how we look at it. But we are very cognizant of the impact on lower income households, which is why we haven't been adjusting that levy for the last 3 years. If we go down. Sorry, next slide, Keta. In terms of, there was a question on the gazetting of the notice. We are working on that. We do hope the notice will be published quite soon. Just as a point, Parliament may decide to intervene. There is legislative oversight in that notice needs to be approved through the Taxation Laws Amendment Act, which will come through these committees. And we can have further discussions on that, and my legal team is here as well to assist. Next slide. There are a few comments on the excise proposals for alcohol. As I mentioned, we didn't change from the March budget, so it stayed at 6.75. Because the expected rate of inflation was slightly lower, the real increase was slightly higher, and in effect, we are getting a little bit more revenue. Our general point is that at a minimum, this should be going up by inflation. If you go back, sorry, here, this should be going up by inflation. We are trying to reduce the consumption of these products. So prices do go up, and we are trying to reduce their consumption. There is a concern about illicit trade, both in alcohol and tobacco. Hopefully, some of the additional allocations that are provided to SARS can be used to mitigate these impacts on illicit trade. On the alcohol tax, we have done a discussion paper that we published at the end of last year. We have received comments. There will be a consultation period this year where we will have consultation workshops with stakeholders on our approach to alcohol taxes going forward to see that we can try and provide more certainty for industry, and we hope those engagements will go well. Next slide. There were also questions from the retailers around reintroducing a zero rating. We stated that we have pulled the zero rating because there is no VAT increase anymore. We have always stated that we believe zero rating is a blunt instrument. It is not the best mechanism to assist lower income households. We should rather do that through the expenditure side, which is what we have done this year by providing above inflation increases to grants. There are a lot of calls, though, to bring those back. We do note, and we put it in a previous slide deck, that the price reductions after you zero rate products is not fully passed on to consumers. So around half of the previous zero rating benefit that we did in 2019, around half went to retailers and half went to consumers. So it's not a foolproof way of trying to assist consumers. In a lot of the discussions on some of those products, even after zero rating, the products will still be at a high price and could still be unaffordable to households, which is why we do not agree with that approach. And we think it is a reasonable proposal to remove the zero rating in this May budget. Thank you. That's all from my side. I think it's time for Marumo. Thank you.
Good morning, Honorable Chair and all the members. I will take you through the fiscal policy and fiscal framework issues. I think there has been some different views that were presented by our stakeholders around our fiscal strategy, with some views saying that we are not doing enough on the fiscal consolidations. We need to implement stringent fiscal consolidation, taking into account the low inflation environment and try and rein in the debt. And while the other views are that we are actually implementing austerity measures because we are not responding to the social ills or the social needs of the country, etc. And for us, in presenting our fiscal strategy, we don't really think that it's a matter of a choice between these different views. And we believe that it is important that the fiscal strategy that we present, it's balanced and it takes into account all these matters that various stakeholders have raised. Hence, as is already indicated or presented by Acting DG, we've presented a strategy that aims to stabilize the debt using primary balance as an anchor. And while we're doing so, we know the fact that we need to continue supporting social wage as well as investing in infrastructure. So that's how we framed our strategy. But starting with this slide, I just want to start by indicating why it is important for us as government, as the Treasury, to increase our effort in trying to deal with in managing our debt and using this primary surplus as a fiscal anchor to try and close the budget deficit that have been there over the years. And I think if you can look at the graph that has been projected, the left graph, that shows the main balance versus the expenditure over the years. I mean, since 2009 and 10, as government, we've been running large persistent budget deficits with expenditure represented by the red line graph, they're consistently higher than the revenue that we've been collecting over these years. And as a result, what we have done is that we've increased our debt from 627 billion rand in 2008 and 9 to 5.3 trillion rand by the end of 2023-2024. And we project that the debt will continue to increase over the years, and it will reach about 6.8 trillion rand in 2027-2028. And as a result of that, if you look at now at the graph on the composition of consolidated expenditure, you look at the middle line that is represented by the blue bar, which is the interest and rent on land, which basically the item that we are using to pay our debt service cost. As a result, I mean, our debt service cost as a share of total consolidated spending has increased from about 8% in 2008 and 9 to 11% in 2016-17, which is represented by in the first bar of this graph, and it continues to increase. I mean, by the end of 2023-2024, it had actually doubled to 16.1%. And it continues to increase, and it will grow to 17.4% in 2027-2028. And what this has done, the growth in debt service cost as a percentage of consolidated spending has done, is that it has then started to crowd out spending in other areas. I mean, we look at the wage bill, which is represented by the maroon bar below. It was accounting for 35.5% of our total spending in 2016-17. It has now decreased to 31.6% in 2025-2026 as debt service cost has increased. Goods and services, where the item that we use to pay for critical goods and services like medicines, books, and others, has also declined as a share of consolidated spending. I mean, from 15.1% in 2016-17 to just about 13.7% in 25-26, and it continues to decline over the MTF. I think the one positive element is that our infrastructure investment, which is represented by the second small bar from the top, we are starting, those investments are starting to restore the share of infrastructure. I mean, it was 5.5% in 2016-17, and it declined to a low of 3.6% in 21-22, which was the period of COVID, and it's starting to peak again from 4.9, and it will increase to 5.2. In other words, restoring that share over time, as and when we continue to invest or pump money in our infrastructure investment. And what this means, honorable members, what this means is that, I mean, from 2009 and 10, every spending additions that we've been proposing, whether it was higher than anticipated wage increases, the OSDs, the bailouts, and any other additional spending. We've been funding those spending through borrowings. And we are saying from where we're sitting that that's not sustainable if our debt service costs continue to behave in the manner that it is behaving, which is a crowding out effect. Next slide, Keta. And here we also emphasize the point on why it is important for us to stabilize the debt in the current financial year by growing that primary surplus, reduce our budget deficit, which will consequently over time lead us to a zero balance budget that some of the colleagues have presented. Because as and when the budget deficit goes down, and the primary balance increases, I mean, they will get to a point where the revenue that we collect should be enough to cover all the commitments, our expenditure commitment, including the debt service cost. But if you look at the first line graph, 2008 and 9, I mean, our debt to GDP was only 26%. And because of these large persistent deficits that we've been running over time, it has now increased to that 77.4% that we are projecting for the current financial year. And the graph on the right just shows how the debt service cost has increased versus nominal GDP. It has consistently been higher than nominal GDP since 2018. And we're saying that this is not sustainable. This trajectory is not sustainable. Hence, it is important that as and when, from our side, as and when we continue to support the social wage and we deal with other pressing needs, that we don't neglect the fact that we need to put measures in place to try and deal with this problem, as the other colleagues have presented. Next slide. And hence our fiscal strategy, because our fiscal strategy, it's not leaning towards any of the, at the extreme of any of these different views. I mean, our fiscal strategy, as we indicated, yes, we want to narrow our budget deficit to 3.4% in 2027-2028. We want to increase our primary balance. We want to support, as I said, the social wage. We want to invest in infrastructure with additions that have been added, as well as, I mean, dealing with all other issues that are affecting our social services. But we understand the fact that, I mean, all these things will need to be balanced. In other words, you're not choosing the one over the other. So we need to present a strategy that takes into account all these inputs that would have been presented by our stakeholders. And in doing so, obviously, it then becomes a difficult exercise because we're not leaning to the extreme of each of the views that have been presented. And we're saying that moving forward, I mean, and as already outlined by my colleague that has just presented, I mean, all other spending pressures or spending needs that will need to be funded in future. From where we're sitting, we don't think that will come here and propose that those funding be funded or those additions be funded through additional borrowing. We will continue to come and propose additional revenue sources that will need to be implemented in order to fund such spending pressures, which is what this budget has done, and as my colleagues has already presented previously. Next slide. And then in this slide, we're saying that, I mean, as part of the strategy, and I've already indicated that, is that we did prioritize spending on issues like capital as well as critical services. And we are encouraged by the fact that our payment for capital assets has increases on average by 7.5% over the next 3 years. However, what that doesn't make us sleep at night is that 7.4% in debt service cost. We want to see that 7.4% moving forward decreasing, while other items like goods and services, which are critical item, housing, other priority areas, increasing and surpassing the debt service cost, including with transfers and subsidies. So we want to see those critical items increasing while debt service cost is reducing, and hence we continue to belabor the point around our fiscal strategy. Next slide. I think on provisional allocation, there's been a lot of questions that have been raised around the strategy on this allocation and why we make this allocation provisional, and what are the mechanisms that will be used once Parliament has approved or has passed the bill. I think the point to make, the first point that we need to make on the issues of provisional allocation. I mean, the 108 billion rand that we presented, that whole amount, it's not entirely the amount for provisional allocation. So the provisional allocation only accounts for 141 billion rand of that amount, and the remaining 39 or 38 billion rand is the money that is already in the baseline of the departments. And part of that, an example of that is the SRD grant in the first year. So SRD is part of the 180, but it's in the baseline of the department. And the reason why we make this provisional allocation is to ensure that, I mean, or these are funds that are set aside for specific purposes and are only made available when the departments, provinces, and local government demonstrate readiness to implement the program that they would have implemented. And we also, I mean, with regard to provinces and local government, we also, before we make this allocation, we also engage with the sector department at the national level to agree on the allocation methodologies, as well as any condition that might need to be set before these funds are allocated. So that work is the work that will need to be done before we make the allocation. And there are two ways in which the allocations can be made available. I mean, the one is that as soon as the appropriation bill has been processed and enacted, then we can invoke Section 6 of that appropriation bill and release these monies for the department to spend. And the other option is that we can use the MTPBS and allocate these monies as part of the adjustment processes. And there we just reflecting on some of the provisional allocations, the 20.8 billion rand in health, which is going to assist in safeguarding about 4,700 posts, dealing with the issues of unemployment, unemployed doctors, as well as accruals in goods and services. And then the education one is to deal with the pressures as well as improving access to ECD. And those are the allocations that can be released once the bill is enacted. And then on early retirement, the early retirement will be released upon application by each of the departments that will be qualifying, and after an assessment would have been done. And the other point that the colleagues have raised, it's around the issues of planning and credibility with regard to this allocation. And they were asking questions as to why this allocation not been allocated upfront. And I think, I mean, my view, I mean, is that in an environment where we had attempted to do a budget 3 times, I think that the approach for provisional allocations might necessarily be a good approach or a better approach in dealing with these issues moving forward. Because, I mean, that on its own could have affected the department if we had allocated this money upfront. I mean, for example, if the 253 billion rand that we had proposed in February was allocated to the departments, and they go through the process of planning and putting together the databases which they submit to the National Treasury, and then we come back to them and say, well, I mean, that money that we've given to you, I mean, it's no longer available because the funding mechanism that we wanted to propose was not accepted, and therefore we are revising the allocation down. And this is the new amount, 108, and they do the same thing on the 108. We come back again, I mean, on the 232, which was the new proposal. And then we in 2.0, we come back again, we say, here is the new proposed allocation. We're reducing the 253 to 232, readjust your plans. Department going again, doing that particular work. and subsequently with regard to asking them to do the same thing with budget 3.0. I think that on its own would have disrupted planning in a greater deal at institutional level. And in fact, it might have even affected our timeline in tabling all those, in those attempts with budget 2.0 as well as the 3.0 that has been tabled. So we think that, this might necessarily be the appropriate approach, where you come to Parliament and say, these are the additional allocations that we intend making to the departments, and these are the problems that we want to address, and this is how we want to fund these allocations. And once you approve, as if the Parliament agrees and you approve them, then we'll release them to the departments. Next slide. Then in terms of infrastructure, I think without belaboring the point around the investment that we made and the issues that have been raised, I think we also, take the point that just making the investment alone doesn't necessarily translate into deliver. There has to be issues of capacity building and to assist the institutions that are responsible for implementing this infrastructure to deliver on those promises. And we are doing that work together with the DBSA, the GTEC, as well as Infrastructure SA, to assist the department and municipalities in planning and packaging the infrastructure project. And there is work as well that we are doing through the PFI to capacitate this department and municipalities through training in order for them to assist them in infrastructure planning as well as appraisal guideline. And there is also work that Treasury is doing through what we call the Infrastructure Delivery Management System, which also assists provinces, municipalities in planning and delivery of infrastructure. So we do understand that just putting the investment alone will not necessarily translate into the actual product at the end of the day. And we are improving also our monitoring capabilities to ensure that we hold the departments and the entities that are responsible for the delivery of this infrastructure accountable. Next slide. And then there were also issues that were raised with regard to the triple Ps, and that triple Ps might not necessarily be a cheaper option of funding our infrastructure. And we are saying that, in an environment where there is a constrained fiscal environment framework and competing priorities, it becomes important that we look for other alternative way of financing our public infrastructure project. And the triple Ps are one of those options, and they account for only 2% of that investments that we've put in place, and we think that there are benefits from these moving forward, and we are doing some work to ensure that we reduce the procedural complexities in implementing the infrastructure as well as the regulatory framework. So the Treasury is making trying to deal with some of the red tapes that are hampering the implementation or the usage of triple P as a funding option. So we are doing some work around it, and we think that we need to continue to leverage on the expertise as well as the innovation that these options brings in funding public infrastructure. Next slide. I think there has been discussion, and my colleague Chris has touched on it, around the issues of social protection and whether we are reducing our social grants, and we are indicating that the additional funding that was added into the grant was to compensate for the VAT increases, and the only withdrawal that we are making in the 2 outer years was in related to that VAT cushioning. But in the first year, which is the current financial year, that cushioning will increase. In other ways, the above inflation increases in social grants will continue, and they might even help in assisting the recipients in dealing with any impact that the fuel levy increases might bring. Because I think one of the questions that was asked is what is it that what is it that you've done to ensure that you cushion the recipient? Then in terms of the issues around conditions that are imposed, with regard to electronic checks, I mean, we believe that, I mean, this is essential to avoid double dipping. And we know that there might have been some court cases which have been challenged around these issues, because from where we are sitting, we think that it will be a big fiscal risk if there is no verification on the recipient of social grants in general. So we think that it is important that, I mean, to avoid double dipping and further fiscal risk into the framework, that there is a verification on the recipients, including the banking details of those recipients. But we do note that, I mean, the matter is currently, I think, under court processes. On SRD, the SRD has been extended for this financial year up to March 2026. And there are allocations that have been set aside in the provisional allocation in year 1, in year 2, and year 3. And those allocations will be informed by the work that the GTEC is doing around this active labor market policies review. So I think once the recommendation of that work comes out, that will give us a sense on how we proceed with these matters, including with the issues that relates to the basic income grant, which is currently under a policy consideration, taking into account our the state of our fiscal or our public finances. Next slide. I think on the spending reviews, I think we take the notes and the feedbacks that have been given by our stakeholders and the inputs around the spending reviews. And I mean, we are already building on those that have been conducted by government. And I mean, we've completed quite a number of spending reviews. And I think in the presentation that might have been circulated, Honorable Chair, if I must apologize, we instead of saying completed, we said implemented. I think the right sentence should have been the spending reviews that have already been implemented. So we are building on those spending reviews going forward to try and identify some of the programs that can be targeted for closures. And I think as one of the, I think one of the colleagues might have already indicated, I mean, the doing a spending review is one thing, but implementing the recommendation is another thing. And that the implementation of the recommendation will need a strong political will. And in my view, I think that's where Parliament can come in, because Parliament can play a bigger role in ensuring that some of these recommendations are implemented by holding the institutions that are responsible for implementing those recommendations accountable. So in other ways, I think, I mean, there is a need where we establish a process where the Treasury and any other department that we have done the spending review to come and present the spending review in Parliament, including the recommendation and how those recommendations have been taken forward. And we do have in our website, because there were issues around whether we are doing this thing in our own little corners and we are not being transparent about this review that have been done. I think those are available in our website for everyone to check and assess what the finding of those reviews are. I think I'll end it here, Honorable Chair, and hand over to my colleague Ravesh to deal with the debt strategy management issues as well as the state-owned companies. Thank you.
Thank you, Marumo. Good morning to the Honorable Chairs. Good morning to the Honorable Members and valued stakeholders. My name is Ravesh Rajdal. I'm acting head for the Assets and Liability Management Division, and I'll take you through some of the responses to the questions around the debt management strategy and state-owned companies. If Keta can move to the next slide, please. So just dealing with some of the questions around our debt management strategy, I think it's first of all, I think it's quite important just to reflect and highlight that we do publish our debt management strategy in the budget review and the NTBBS, and obviously it includes some tables and also portfolio risk guidelines. But I think it's quite important just to highlight that government's debt management strategy, obviously we look at the decisions that we need to look at. How do we balance the strategy in terms of the key 3 principles, which is around costs, risks, and liquidity. Just just highlighting these three strategies in terms of that, how do we go about doing that? I think it's important just in terms of from a liquidity management perspective, we ensure that there's efficient cash that's available to meet our obligations as they fall due. Then also from a refinancing risk management perspective, we also minimize the risk of our large debt redemptions within the short timeframes. And then the cost of borrowing is we obviously achieving the lowest possible financing costs over the long term within obviously acceptable risk parameters. Now, obviously, these are all underpinned by a strategic risk framework. So which government actually manages the compositions of its debt through a portfolio of a mix of instruments, currencies and maturities, just to highlight the funding mix, the diverse funding mix that we have. We've got 89% domestic debt, 11% foreign currency debt, obviously keeping our foreign exposure within the strategic risk benchmark of 15%. And we also do ensure that external financing sources, including multilateral development banks, international financial institutions and capital markets, which can offer favorable terms and also support our foreign reserve accumulation. Moving on to the maturity structure optimization. Here we basically look at a mix of short and long-term borrowings that basically is deployed to balance our cost and refinancing risks. We also do undertake bond switch programs. You used to exchange shorter dated instruments for longer maturities, so which helps smooth our redemption profile and obviously reduce rollover risks. Then moving on to the strategic use of GFECRA. I think here from the GFECRA point of view, obviously we have 100 billion rand that we have in 24-25 and 25 billion in the 2 out years, and obviously these funds will be used to reduce government's financing needs, which will lower debt and debt financing costs. The GFECRA settlement obviously ensures that SARB cannot use its reserves, thereby mitigating liquidity and exchange rate risks. So obviously all of this that that I've mentioned, has to obviously look at how do we, make the choices in terms of instruments, and also, looking at the various trade-offs. So I think and we think that a prudent strategy requires a deep understanding of these risks and costs associated with each instrument to ensure that the debt remains sustainable, affordable, and resilient in the face of the economic shocks that we face. Moving on to the next slide, Keta. Okay, I don't see it moving on my side. But there we go. So there was a few questions just around some of the suggested sources of funding, and here we're just responding to those. The first obviously was this around why not we just tap into the to the GFECRA. Here, I think just to underscore the core principles is that the GFECRA obviously is underpinned by the GFECRA Act, which is designed to protect the credibility, independence, and stability of the SARB and the economy. It also guards against your currency fluctuations, as I mentioned before, to plug fiscal holes in ways that could backfire, obviously, if the currency strengthens or external conditions deteriorate. Short-term currency gains should not be used to finance long-term spending, long-term spending commitments. So the settlement arrangement, therefore, does not allow SARB to use currency reserves in this regard. There was also a question around why not do we look at the GEPF pension contribution holiday, and here we want to also spend a bit more time just to underscore that the fund rules here under the GEPF state that any amount which a member employer is legally obliged to pay to the fund shall be recovered from the member's pensionable emoluments or the employer. So if the employer does not pay the contributions within 7 days after it becomes due, interest shall be paid by the employer to the fund at the rate prescribed as from such due date. So therefore, a pension contribution holiday isn't a saving in that sense, but rather what we're doing is we're borrowing from the fund, and that becomes a contingent liability, which means that the state is the guarantor to the fund, and obviously risks associated with its funding level will therefore affect the fiscal framework in the future. So we may have to then come in and assist making good on the withdrawals that have been taken out from the GPF. So I think it's quite important to underscore that, honourable members. Then there were also questions around, there are many funds like PARA, etc. Why don't we use these funds to finance government debt? I think it's also here important to underscore that these funds are used for specialized and designated purposes. So if there's a decision to tap into these funds, it's quite important to highlight that it's not a Treasury decision. This will have to be basically a cabinet decision, where then cabinet will decide whether these funds should be utilized for funding the gross debt. So obviously these acts will then need to be amended, and obviously that can only happen through an act of parliament, and obviously there's a process which has to be undertaken there. I think just moving along swiftly to the next two slides from my side, which basically deals with just giving an overview on some of the responses to state-owned companies. Here we'd just like to again just highlight, which we've done in the previous budgets, that the SOCs do remain a fiscal risk. They remain distressed. However, just focusing on Eskom, we see that there have been some considerable progress in terms of its recovery plan. Obviously, Transnet is hampered by high debt levels, and they need to make faster progress on its recovery plans. The DFIs continue to support economic growth. Just in terms of the theme, in terms of our stance, in terms of bailing out state-owned companies, we maintained our stance in terms of not bailing out or providing bailouts to state-owned companies. We will, however, support the state-owned companies through critical capital investments, through different mechanisms, as we've mentioned before, including credit guarantees, on lending, and grant funding where appropriate. Lastly, I think on this slide is also important to highlight that we do get requested to come to the Standing Committee on Appropriations to present on a quarterly basis on just on the status of the state-owned companies and compliance to any conditions, including guarantees and recapitalization. So there is that transparency that we provide in terms of just ensuring that any guarantees or historic support that's been provided, we therefore account to Parliament in terms of ensuring that we do respond to the request to account in terms of compliance to these conditions. And then moving on to the last slide from my side on SOCs, we just wanted here to underscore again and just highlight the questions. There were some questions around the Eskom debt relief package, around the debt takeover. So I think here just to highlight that at the time of the debt relief package, obviously it was decided that and approved through the Eskom Debt Relief Act that will provide through a combination of a loan which will be converted into equity, and then the 70 billion debt takeover. However, since then we've had a revisit and relook at the whole arrangement, and we've basically looked at the complexity and looked at the difficulty of executing the 70 billion debt takeover. So we've agreed with Eskom that we revise the debt relief arrangement from a initial debt takeover 70 billion, and then we'll basically and at the same time reduce it to 50 billion because of the improved financial position. And that basically 70 billion has been reduced to 50 billion, which will be advanced as we're doing with the rest of the other debt relief package in terms of a loan converted to equity, so that there will be advances of 40 billion in 25-26 to redeem debt that's maturing in April 2026, and then a further 10 billion for debt maturing in 28-29. So the advances basically of the 40 billion will basically help to address its short-term cash flow position. And I think it's also quite important to highlight to the honourable members that the debt relief package has now reduced from the 254 to the 230 billion. And again, just basically the reason for that is obviously it does reflect the improved financial position from Eskom perspective, and hence we've reviewed the whole debt relief arrangements, including the debt takeover. Chair, I think that's all from my side. I now hand over to the acting DG for conclusion. Thank you.
Thank you, Ramesh. Thank you, chairs, honourable members, and stakeholders. Please allow me to first reiterate our appreciation for the many inputs that we've received that we continue to consider in the upcoming iterations of the budget cycles to follow. These are very important and help us to improve our thinking around the budget process and how we can make it more consultative and transparent. And this, in fact, has found expression in the budget documentation in innovations, for instance, like the gender budget statement. As far as the fiscal strategy is concerned, the 2025 budget reaffirms our commitment to supporting the social wage, economic growth, while maintaining the fiscal strategy through stabilizing debt. While doing this, we are investing in strategic infrastructure, supporting job creation, and maintaining growth-friendly fiscal policy, which underpins government policy over the medium term. Finally, we will continue to pursue budget reform to ensure deeper and richer political and technical debate around the trade-offs that are inherent in budgeting, which we have spoken to over the course of this presentation. I will leave it there and hand over to you, chairs. Thank you very much.
Mawibus, you took all our time. But anyway, thanks very much for the response, because I thought you were going to share your time from 9:30 to 10:30. Anyway, I'll see how much I can give. I can extend the time to SARS. Can I check who's available from SARS? Is the commissioner on the platform? I don't see.
No, Chair, the commissioner is not here, but I see Franz Tomasek from SARS is here.
Okay.
Good morning, Chair and honourable members. First of all, the Commissioner extends his apologies for not being here this morning. He had other commitments, but SARS's interventions here are fairly limited. There were three key issues that were raised. The first was a question around how SARS administers VAT zero ratings, with particular reference to dairy liquid blends. So here, I think the first point to make is that every time there's a zero rating, it creates a boundary that SARS needs to police to ensure that only qualifying products are zero rated by vendors in those products' value chain. So coming now to the particular point around dairy liquid blends, the Department of Agriculture's regulations on classification, packing, and marking of dairy products lists 18 different dairy product types. And 3 of those are currently zero rated. Those are milk powder and dairy powder blend. It's milk and cultured milk. Now, dairy liquid blend is included under a separate type under the regulations. And so SARS uses those regulations to assist in determining which category a particular product falls in and whether it qualifies for a zero rating or not. And in this regard, it's perhaps useful to mention that a manufacturer unsuccessfully challenged SARS's interpretation that dairy liquid blend did not fall under milk in 2021. So that just gives you a brief insight into that aspect. Illicit trade was raised. That's something SARS is well aware of. It's something that we keep a close eye on and work towards countering in the alcohol, tobacco, and other excisable product space. We very much appreciate the acknowledgement of the impact of the Minister and SARS's interventions around the substantial abuse of duty-free alcohol sales to certain diplomats. That was a fairly long project. It involved court challenges that went all the way to the Constitutional Court, but ultimately we were successful in countering that. SARS follows a multi-pronged strategy to combat illicit trade. So that includes legislative interventions. So in the tobacco space, we've seen mandatory cigarette manufacturer counters introduced. There have been provisions introduced to allow for the installation of CCTV to monitor the manufacture and distribution activities at manufacturing warehouses. But again, here, this is something that is subject to current court action, and we'll have to await developments there. We have frontline interventions at ports of entry points, and we conduct joint operations with other law enforcement agencies here. We have compliance audits. We have a specialized syndicated tax and customs crime investigation. So illicit trade is something that forms a part of SARS's revenue recovery plan, which I think will be expanded on when we talk about our APP. And then finally, there were some questions around the additional funding to SARS and how quickly we would be able to start delivering results on that. Your members will appreciate that we need a ramp-up period to employ, train, and equip the staff using the additional funding allocated for debt recovery. And as the Commissioner has indicated previously, this has begun. Our initial focus is going to be on undisputed debt, but that will need to be underpinned by revenue recovery measures targeting the tax gap as we move into the outer years. As has already been mentioned, the results will be reported monthly. And bearing in mind the ramp-up period, we're expecting those efforts to start gathering pace by the beginning of the second quarter of this year. And as mentioned already, this is something that we rather hope will enable the Minister to reconsider the tax increases that have been penciled in for the 2026 budget. So there we go, Honourable Chairs and Members. I hope that helps on the three issues that were directed towards SARS.
Wow, thanks very much. I was worried because the time allocated was until 10:30. Thanks very much. Members, I think now we will allow the public to comment on the response.
Yes, Chair.
Yes, I think we'll just have to list them. Can we get the PASA, Poultry Association of South Africa?
Thank you, Chair and honourable members. Having listened to the presentation this morning, what we are asking for VAT to be exempted on frozen bone-in portions and fresh and frozen offal. 36.6% of our low-income children in South Africa is stunted physically and mentally, impacting the rest of their lives, making them less productive citizens, sometimes that we can ill afford. Zero rating chicken, as defined is a small price to pay to get 36.6% of our children to become productive citizens in this country. The definition used in this submission of frozen bone-in and fresh and frozen offal cannot be circumvented easily, and the benefit will go to the poor. The total cost to the fiscus will be 4.9 billion rand as reported, but that's only 0.28% of the total revenue projected, a price we pay for massive return on investment. The return on investment is continuous and long-term. Productive future citizens, people that will make improved decisions. Now is the time to act and declare chicken as defined VAT-free and help the 36.6% of our children from low-income households to achieve physical and cognitive competence and put them in a position to be adding value as citizens of this country. If the 4.9 billion is an issue, as stated in the presentation, let's start with fresh and frozen offal, as was allowed within the budget number 2. The grant route will obviously not focus enough to address the issue of malnutrition if we take that route. Thank you, Chairperson.
Thank you. Clover SA.
Good morning, everyone. I'm Amelia Pabian and I'm a legal manager from Clover. I want to start by thanking you for considering our written and our oral submissions, as well as your valuable feedback. We do believe that government did make the right policy decision in the first and second iterations of the budget, which included the zero rating of dairy liquid blends or DLBs. In contrast to today's feedback, government has already itself argued in budgets 1 and 2 that the benefit of zero rating certain products such as DLBs is indeed transferred to poor consumers. There are monitoring mechanisms available to ensure that low-income households benefit from zero ratings, and there is evidence that this does indeed take place in practice. And if I am to use the minister's own words, zero ratings are a concrete step to protect vulnerable households from the pressures of cost of living. So we firmly agree with the minister and therefore consider it a no-brainer to include the zero rating of dairy liquid blends in the current budget. This is even more obvious when one considers the anomaly between dairy powder blends, which are zero rated, and dairy liquid blends, which are not. And this is purely just arbitrary. The loss to the fiscus should DLBs be zero rated is really minute in comparison to the loss of VAT due to the scrapping of the VAT increase. We're really talking about a loss of approximately 65 million due to the zero rating versus a loss of 10 billion due to the reversal of the VAT increase between budgets 2 and 3. So we are of the view that making one dependent on the other is really not a valid enough argument. We believe in the positive impact which greater accessibility to DLBs could have on those who are less privileged, considering the product's nutritional value, and we will continue to argue against the arbitrary distinction between dairy powder blends and dairy liquid blends. Effectively, the only difference between DLBs and DPBs is the presence of liquid. We are firmly committed to keeping the VAT zero rating of DLBs on the agenda, and we really look forward to further engaging on this with the government so that we can eventually get this over the line. Thank you very much.
Consumer Goods Council of South Africa.
Thank you, Chair, and thank you to the responses from National Treasury and SARS. Chair, we just like Clover, believe that government actually made the right decision in the first and second budget. Chair, the status quo, if it persists, and scrapping the zero rating does not really guarantee that poor households can afford this. We have an increase to 0.5, and there's evidence right now of malnutrition, of people going hungry, and food insecurity. I don't want to belabor the points, and I think the point has been made by colleagues to say that, that the loss to the fiscus is very minute. And to say that zero rating is used as a blunt instrument, it really is perplexing, because the very items that were proposed to be zero rated were actually chosen by National Treasury. And I'm hoping that those were chosen because some kind of research informed why those items, and the conclusion, therefore, the logical conclusion would be that it's because evidence showed that it's the very poor that actually consume and buy those products. Now, to say that there is no evidence that it only will benefit the poor, but the rest of consumers, really goes against the very argument that National Treasury put in the first place to want to zero rate these products. Chair, I think, what is becoming evident, and it was raised 2 days ago by some of the members and honorable members, is the need for consultation. We would like to have an engagement, sit in a room with National Treasury and SARS and look at what are the items, how zero rating can actually benefit our industry, because sitting in Pretoria and where National Treasury sits without actually having the insights of the very industry that is at the coalface of dealing with consumers may actually work at cross purposes. I'd like to invite National Treasury and SARS that we further consider the lists and agree and see evidence, real-based evidence from the people that are on the ground, which is our members and retailers. Chair, also, there is a discussion that is happening at NEDLEC on the cost of living, and food is really big on this. I'm sure our colleagues from COSATU will actually, also support the fact that National Treasury and government are not really part of these discussions, right? We need to have National Treasury and SARS becoming part of these discussions so that they can actually provide wisdom, but more importantly, become part of this national debate that looks at solutions of reducing food insecurity. And lastly, as I conclude, I'm very encouraged by comments from SARS, and we saw it also in the budget vote that the fight for illicit is going to be intensified. Again, I'd like to extend an invitation to government to say that it cannot be just solutions that are government driven. Let's look at the solutions that are sitting in the private sector that looks at best practices across the globe. We talked about GS1 standards, and SARS themselves have been invited to come to some of our laboratories where we've demonstrated how these standards can be used to improve supply chain efficiencies. So my parting shot is it's about time that we have more engagements without actually coming to Parliament after the fact, but as we're considering solutions that are geared towards reducing the socio-economic challenges of our country, let the private sector and government speak so that the solutions are practical and geared towards consumer protection. Thank you very much, Chair.
Thanks very much, Consumer Goods Council of South Africa. PEP, Public Economic Project.
Good morning, Honourable Chairperson, Honourable Members. Firstly, we'd like to thank you and the Honourable Members and Parliament as a whole, the Legislature, for having the stamina to consider the budget for the third time this year. And it also indicates that South African democracy works very well, and I think we can be quite grateful that we live in this country where institutions are respected and Parliament and the Constitution are sovereign. And as mentioned in our presentation, we don't have the luxury of merely pointing out, and you certainly don't as lawmakers, the limitations of every single tax proposal or expenditure proposal. You have to actually take decisions. And so we empathize with your position as a public finance think tank. We merely point out the limitations and the merits, but you have to make the decisions. Honourable members, what's come out in this discussion, certainly in the third iteration of the budget and these public hearings, is the imperative of objective analysis and data analysis and data informing decisions being taken. We can't afford a situation in the Finance Committee or in the Appropriations Committee or Parliament generally where we have cherry-picked data analysis to suit a priori positions of interest groups or lobbyists or sectors of society. And I think it's important that Parliament continue playing this role as an aggregator of analysis, but analysis that is objective, that is not captured by a particular minority interest, and is in the interest of the overall country, and especially those that are excluded from the economy, and to ensure public finance sustainability. Our members and us as the Public Economy Project at Wits University would like to continue our relationship with this committee in being an aggregator of evidence and objective evidence that leads to sustainable use of public resources. So again, we look forward to continuing our conversation later on the year, and we thank yourselves and the Treasury and the entire team for putting together the third budget, and we appreciate the efforts going forward. Thank you very much.
Thanks, PEP, Budget Justice Coalition.
Good morning all. Thank you very much, Chair. So yes, thank you very much for the opportunity to respond to Treasury and SARS's presentations. So I think the first thing that I will probably go into is the assertion or the comment by National Treasury around our tax system in South Africa being progressive overall and not to look at individual tax instruments. So a tax system can look progressive on paper, but it doesn't actually function that way. And we know this all too well in a country that is marked by some of the highest levels of inequality in the world. We, as the Budget Justice Coalition, have consistently been critical of our tax system in our country because it's been underutilized. And I think also the UN Commission, the CSHR had also said that we are underutilizing our tax instruments to drive equality in our country. And I think we know this to be because even though there is some form of targeting because of loopholes, profit shifting, and evasion by the elites, what we are realizing is that our tax system is really good at targeting the poor, but not so good at targeting wealthy people and wealthy corporations that exploit our tax system. The true story actually is that our true story of our economy in our country is one of inequality, of poverty and unemployment. And we really need to be thinking about what our fiscal policy has been contributing towards this, because there are interventions and there are things that, my other colleagues will probably go into Operation Vulindlela a lot more in detail, but there are some assumptions around our fiscal policy and we have very little to show for it. And so we're still calling on really looking at wealth taxes and taxes that are better or more robust in targeting the wealthy, and also couple that with stronger enforcement. I also really liked the point that was made around zero rating and it being a blunt instrument. So we agree with this, but we think that Treasury can actually, that argument goes both ways, because VAT and a general fuel levy are also blunt instruments. And so this, because of the impact that it has on the most marginalized people in this country. We've covered this in all of our presentations around the budget this year. And so it does really then speak to how regressive in nature, how successful the regressive taxes aspects of our tax system have been, but not so much the progressive aspects, and the Treasury really needs to rethink that. Yeah, and then there are some points that are welcome, but I think I'll just also close off to say that another point that we do need to think about is around the infrastructure delivery management system, as well as SARS's commitments towards bolstering, overcoming under collection and underspending, both, the revenue and the expenditure side. So we as civil society, and I think as people in our country, need to really be calling on, monitoring and scrutinizing this. And yeah, I think maybe I will just close off with that, because I think that, and just another point about the illegal tobacco that SARS is doing, because I don't know, combating that. I think my comrade my colleague Lisa had pointed out that in South Africa, it is probably easier to get an illegal cigarette than it is to get a legal one. So we really would like to see fruits towards interventions there. So I'll just stop there. Thank you very much.
Thank you, Budget Justice Coalition, South African wide.
Thank you, Chair Christo Conradi. I really appreciate the opportunity. I think just to make sure that I stick to my notes, I'm going to repeat a couple of bullets. And I think post this meeting, all of us need to table a one-pager by 3 o'clock this afternoon. And maybe it's just a good thing, just looking back at my previous one-pager, that was on the 28th of March, the final line there was, any adjustment closer to CPI will be more palatable than the current proposal. So if I need to put up a heading for the next 3 minutes, it will be, is the needle moving? Or maybe, what is the shadow side of stats? I started Friday, no, Wednesday, I started there about the minister saying the commitment to listen to South Africans. That's why that will remain. I'm still asking you this morning to the members and to the committee, maybe you have heard us. I'm not sure that the needle is moving. I'm just looking at the statement of Cabinet yesterday saying this pro-poor budget means on every rand, 61 cents will be spent on basic services, electricity, water. And I think we fully understand that and we support that. If I look at some of the presentations talking about the liquor or the alcohol industry, for the last 4 years between beer, spirits and wine, the excise adjusted more or less the same, but the 1 year a bit higher for wine, another year a bit higher for beer, and then maybe for spirits. And now this year we're all sitting on 6.75%. If I'm looking at the alcohol per capita and the contribution of wine, it's below 15%, while unregulated or the illicit is the second highest, according to the World Health Organization, sitting at 16%. If I'm looking at page 6 this morning and I look at the food inflation for 25 estimate 4.8, and then for the next 2 years 4.5, 4.5, not close to 6.75. If I page to say page 7, then the GDP inflation is 4.4, 4.4, 4.5 for the same period. CPI inflation, 25 estimate, 3.7, 4.2 and 4.3. I don't see 6.75. Thank you to Chris for his feedback. And as a side note, Chris, congratulations with your appointment as DDG and all the best in that chair. And I'm looking just on page 19, and there's 6 bullets there. Bullet number 4, making a comment here, these products that are harmful. You know what, that's quite a harsh statement. It's harmful only when there's excessive usage. And I think we need to be very, very sensitive when we put down a comment like that. For sure, we would like to applaud you for page 9 in terms of continuing with Operation Vulindlela. That's aligned with our landing page in our presentation on Wednesday. Also then looking at the feedback from France in terms of illicit, the multi-trunked, great, we would like to applaud that. But I want to land here and say I'm still maybe disappointed, given the fact that Chris was trying to motivate the reason for above a CPI-related adjustment in excise, and specifically when we talk about CPI plus 2.67. That's the shadow side of stats. That's exactly 65%. 65% above CPI. Looking at volumes, looking at the per capita consumption, then I really don't see why we need to be 2.6% above CPI. Like I mentioned previously, if you look at the national minimum wage, the adjustment of CPI plus 1.5, at least up until now, I haven't seen any adjustment from the presentations of anyone this morning. I will really encourage this team, when you receive our one pages, please consider in adjusting that and bringing it lower, maybe to 1.5. Then you will show your commitment, and then we can work hand in hand in taking it forward and move the needle. Thank you for the opportunity and all the best for the stars. Thank you, Chair.
Thanks very much, Budget Just South African wine. Now I'll call Heineken.
Thank you, Chair. Honourable Chair, honourable members, National Treasury and SARS officials, for your continued work and commitment. As an ex-SARS official myself, I really have a deep appreciation for the work you do. Please allow me also to repeat some stats that I shared earlier this week, just as some context to my response. The consumption of legal alcohol, as I explained, in South Africa is lower than it was 10 years ago. In contrast to that, we're seeing that consumption of illicit alcohol continues to grow both in volume and value terms. The WHO estimated that the illicit alcohol is the second largest category of alcohol being consumed in South Africa. That makes that category larger than both wine and spirits consumption. The value of legal alcohol has increased by 186% since 2014, and this is much higher than the CPI growth of 117% over the same period. This is as a result of continued above inflationary excise increases, but also high increases in input costs that the legal industry faces. Illicit alcohol is therefore on average 43% cheaper than legal alcohol in South Africa. Mr. Tomasek, thank you for your inputs. We applaud SARS's effort, and as a legal industry, we remain an ally to SARS in fighting illicit alcohol. Our concern is that at policy level, decisions to continue increasing excise rates above inflation when we already face such high levels of taxation will erode not only your efforts, but also the investments being made by government in bolstering SARS's resources. And that's really the point that we wanted to raise. Please allow me just to focus briefly on the response from National Treasury, specifically relating to the policy review, which Mr. Axelson briefly touched on during his feedback. Honourable Chair and members, I'm not sure if you are aware, but the policy review that Mr. Axelson referred to contains a bundle of proposals, including proposals to increase excise rates further on wine by 80% and for beer by up to 40%. Treasury did not share in the policy paper that was published an economic impact assessment relating to its proposals, nor was evidence provided on how such increases will achieve both the tax and the health objectives of government, particularly considering the acknowledged threats of a growing illicit trade. And therefore, we are not clear how these proposals will ensure a net benefit to the state and society. We are now standing at the beginning of June, and we have still not received communication from National Treasury on how and when these consultations will occur. We are worried that if these are to be implemented early next year in February, this leaves us very little time for engagement, consultation, and policy finalization, particularly considering the wide-reaching proposals that have been put on the table. Mr. Axelson, you did refer to the new policy providing certainty. I think my concern here is that the uncertainty which the change in the policy will create for a legal, highly regulated, compliant, and productive industry really is enormous. And the changes that are being proposed as part of the review will have a material impact on our economy with multiple unintended consequences, which we do not believe have yet been fully assessed. Honourable Chair, in closing, I respectfully request that National Treasury provide a full timeline and details of how the consultations will be carried out, as well as indications of how and when changes will be announced and the timing of the implementation, really so we can avoid further shocks to our economy, particularly in light of the low economic forecasts we are facing. Thank you.
Thanks very much, Van Niekerk from Heineken. Now, SAICA, South African Institute of Chartered Accountants.
Thank you very much, Chair, and good morning to the members. Similarly, we would like to, I think, start off with congratulating and welcoming the appointment of the 3 DDGs announced yesterday, Mrs. Britton, Mrs. Gerekwe, and Mr. Axelson. And we look forward to the other vacancies being filled and also looking at the other challenges and vacancies at National Treasury. Again, our Treasury Department being another jewel in our crown. Chair, I think just starting off with the beginning on the principles regarding the presentation, the feedback on transparency in regard to credibility. I think the first statement just being that transparency and credibility are two different things. Transparency just being as how much we are able to see. Credibility, as we stated on Wednesday, is much beyond just National Treasury, and there is a collective responsibility for the credibility of the budget. I think just as to the statement in the feedback on attributed to SAICA on tax increases, I think the correct reflection of our position is rather that we find it difficult to support tax increases in a high tax environment when debt is in fact still increasing and not decreasing, and the accountability enforcement remains lacking as reported by the Auditor General this week. And I think that is our position on tax increases. It's not just a blanket statement on reduction. Chair, then just as to highlighting certain of the feedbacks and maybe hopefully something we can add to the later deliberations of the members. I think just looking at, and I'll try and give the page references just for the members' convenience. on page 11 on tax buoyancy, you'll see the 12 months jump of 0.54 to 133. And I think the question is, but what is resulting in that? Is it just more collection that we're seeing? But what, and just for tax buoyancy, obviously the rate at which tax increases are in relation to GDP growth. And we're saying that we're going to essentially collect a lot more taxes than the economy is going to grow. And I think just questioning, well, what is going to drive that? Is it just enforcement, etc.? So what is the underpinnings to that? On the tax strategy, again, we welcome the tax strategy and the confirmation of matching permanent expenditure versus permanent revenue sources. But I think there are still some concerns on things, for example, like NHI. Where's the permanent revenue source for that? If we are going to fund that, SOE recapitalization. And then obviously there are certain excluded things like legal claims that are sitting beyond 120 billion. And are we provisioning for those? Then on page 15, the unspecified taxes were noted or penciled in for 20 billion for 2026. And I think it is important that we start unpacking what those are, given Mr. Axelson's explanation of the instruments available to actually collect tax quite quickly, etc. Those are few and far between. And given what we've seen now in budget 1, 2, and 3, some of those might not carry the support of Parliament. And I think it's better earlier than later that we understand what are those options that if we do need to rely on them come February next year, that we start getting that support now already before the medium-term budget policy statement as to what those are available that Treasury Parliament would have to choose on. On infrastructure, agreed, again, we've all agreed that that is key to the economy. Yet, if we look at on page 22, the explanation, we see that the percentage hovering around 4.9 to 5.1% stays exactly the same. So it's again a bit difficult to see how we are really upping. We've seen the explanation on most of the spending happening at SOEs, etc. But I think there is a difference between spending and actually building per National Treasury's own report on Eskom, on repairs and maintenance since 2008. And I think there's also a realization that at Eskom and Transnet, a lot of the turnaround has been funded by consumers by very high increases in services, not necessarily by efficiencies, etc. So there has been quite a cost paid by consumers to turn around Eskom in particular. Page 23 on the fiscal framework, again, stating the inability to turn around. Again, the promises of turning around debt and that we'll see this bell curve. And again, that is difficult to see given where we are with spending. And I think there the IMF has also made the choice that they don't see that realizing, again, without certain drastic steps being taken. And I think that does need to consider is, will we see the promised bell curve of debt going if we can't control the spending side while we try and sort out the economy? On page 26, the provisioning without allocation. Again, this seems to be a form of a control, which we're not in principle in disagreement. Certain things, there does need to be some form of control where we have a state where certain SOEs and departments are not delivering when they actually get the money. But I do think there does need to be a formal framework, given we're sitting with 146 in this allocated, unallocated. The other question just raised is we saw that SRD grants are also in this, given there's a caption explaining what provisioning is for. And for the outer years, SRD grants are penciled in as unbudgeted and unallocated, yet it's only been approved for 2026 according to Treasury. So just explaining why that line item is there. Then page 27, Chair, additions and expenditure, again, infrastructure and into the metric and building, and we're looking forward to that. The second last comment we have is on page 33 on JAFECRA. And again, people understanding that JAFECRA is unrealized gains and losses. It's not a pile of cash lying around, and it is only drawdowns are going to be once off. It's not a perpetual. And to realize those gains and losses, you actually need to sell something, which means you're losing whatever you're selling, whether it's gold or forex. And again, I think the question we need to ask, given that some of the estimations are of currency appreciation, so a lot of those unrealized gains are because of the gold price at the moment, but also because of the currency has depreciated. The currency is now in an appreciating cycle. How does that impact on those unrealized gains and loss estimates going forward? Chair, then lastly, just to finish off, the last point was on the fuel levy, and obviously the process in there. I think even though Treasury does not support ring fencing, the fuel levy was introduced in 1935 for the pure purpose of making it easy and quick and efficient to maintain and build roads. And it was only in 1988 that the apartheid government, running out of money, de-ring fenced it. And now, as per the presentation, we see that this money is being used for all sorts of things. And again, not a problem if we were speaking about a country that doesn't have potholes or has enough roads, etc. But that's not, and I think that discussion does need to come back here. Are we using that money for the right purposes? And should it not, at least in an interim, be plowed back into our road infrastructure and be ring-fenced at least, so that we focus, given the lack of focus that we currently have in maintaining our road infrastructure, which we all agree is critical to our rebuilding our economy, Chair. That is our comments from the board back. Thank you very much for the opportunity.
Thanks very much, Mr. Peters. Institute for Economic Justice, IEJ.
Yes, Chair, thank you.
Wow.
So
Okay.
we have, may I go ahead?
Yes, I would believe so.
Thank you, Chair. So we have 5 points we want to make. The first is around process, which is much more general. We note that, through these budget consultations, in National Treasury often informs us or makes argument as to why certain tax policies or measures are not feasible in South Africa. For example, they say the corporate income tax rate, if it were to be increased, would be most harmful to growth. They say the revenue potential of a wealth tax is low relative to its costs. The question we want to ask is, might it not be useful, might it not improve the quality of debate if the National Treasury were to publish the research that outlines these arguments, as well as the data that backs up these claims? So in a manner that is similar to what they have done with regards to the fiscal anchor, because they have published a discussion document that allows the public to engage more substantively on the issue. The second point is around G-Factor. So in the previous fiscal year, that is 24-25, National Treasury was able to take out around 100 billion. And there'll be 50 billion rands also allocated for the next 2 years. Could a National Treasury please outline what the drawdowns from that have meant for financial markets, inflation expectations, confidence levels? And given that each factor has swelled up now to around 390 billion, which is 140 billion above what the National Treasury and the South African Reserve Bank agreed was an adequate buffer, which is 250 billion, to protect against currency fluctuations, might there be considerations to draw further on this account? Our third point is around the SRD grant and social protection in general. So in a meeting of the Portfolio Committee on Social Development, which was on the 23rd of April, SASSA revealed that the National Treasury had for the first time attached conditions to its operation budget. And these conditions kind of compel SASSA to introduce, amongst many things, bank checks, database checks, biometric verification, and to report to Treasury on the number of grants that were cancelled. Now, this is kind of extending what were deemed to be unconstitutional measures that were put on the SRD grant. It's extending them to other social grants as well. And there is overwhelming evidence that these checks, these ways of verifying wrongfully excluded millions of people that should have received the SRD grant. And also there was the court ruling which said this was unconstitutional. So we want to ask, was the court ruling and the evidence of the extent of wrongful exclusion considered in the setting of these conditions, and what was the motivation? One of the officials also spoke about double dipping. We want to understand is, would Treasury be willing to release the evidence that they used to claim that there is a large extent of double dipping? Our fourth point is around international finance institutions. So this committee about 2 years ago recommended that the loan agreements that the country signs with institutions such as the World Bank and the French Development Bank should be put up to Parliament for Parliament to scrutinize the financial terms as well as the policy conditionalities, and for Parliament to ratify these loan agreements, which is commonplace in other parts of the world. And we know much of this money is taken for the just energy transition, which kind of aims to mobilize upwards of trillions of rands in the coming decade. And much of this will be in the form of concessional loans. So we want to ask what progress has been made to ensure that Parliament does adequate oversight over this kind of lending. Our fifth point is on debt renegotiation. So want to ask, are there any prospects for debt renegotiation of some of the outstanding debt which the country has in order to reduce our debt service costs and contingent liabilities, in particular the outstanding debt of state-owned enterprises, a large share of which is held within the public sector, such as the government employees pension fund. And then lastly, the budget reviews, outline some of the infrastructure projects that are set to be undertaken, but there really is no detail as to how these projects will be managed. Now, I want to ask, where might the public be able to access information related to how these projects will be managed? Thank you, Chair.
Thanks very much. Alternative Information and Development.
Thank you. Can you see my screen?
Yes.
Great, thanks. So thank you to Treasury and SARS for the responses and for the opportunity to give some comments on this. I am from the Alternative Information and Development Center. I think on the Treasury slides we said it's stated that we were from the automotive industry, so I just wanted to correct that briefly. I just wanted to also talk a little bit about just reiterate some of our points made during the presentation. While we can see a reduction in the debt to GDP ratio in the medium term and a growing primary balance, which is at the bottom of the screen in red, this is not being met by a corresponding decline in the debt servicing costs. And more importantly, it is also not being met with an increase in non-interest expenditure, even in the outer years. So what we can see is that if a growing primary balance is not being met with increased expenditure in the outer years, then frontline services will continue to be sacrificed, and we have the outputs of declining debt to GDP ratios, but we do not have the ultimate outcomes of improved expenditure in critical services. And so we're questioning whether the fiscal consolidation strategy is self-defeating in a way if we are not able to be obtaining higher expenditure, especially in the outer years. There was also a point about the GPF, and we just want to briefly say that while we acknowledge the responses by Treasury, we're just asking if there could be consideration around possible amendments of the legislation, considering that the GPF is 110% funded, and it could be a potential progressive alternative revenue raising mechanism. There was also constant referral to the fact that the tax system in South Africa is highly progressive, and this graph comes from a fiscal incidence analysis study in 2015 by Woolard et al. It's quite outdated. This is because Stats SA has not regularly been collecting income and expenditure surveys, partly due to austerity and budget cuts. But the main point is that what we can see is that there is high levels of progressivity in the South African tax system. So and this can be demonstrated by the steepness of the curve compared to the slopes of the curves to the other countries. So South Africa is measured in gray at the top. And what we can see is that the market income Gini coefficient is 0.77. And even after the high levels of progressivity, our final income Gini coefficient, so this is the Gini coefficient after taxes and transfers and benefits and free basic services, is still higher than the final Gini coefficient is still higher than the market income inequality for all other countries. So what we are trying to highlight and state that even though the South African tax system is progressive, given that the initial levels of inequality are so high and like the highest in the world, we should be having exceptional levels of redistribution to be addressing this. And we don't feel that the current tax system currently tries to maximize and enhance the progressivity of the tax system as much as possible and as much as feasible. And our last point is just around Operation Vulindlela. We acknowledge the different reforms that have been made and the outputs, but again, we need to be focusing more on the outcomes. We want to be like, so I've tried to look at the evaluations that is available on the State of the Nation website, but we can't really see the direct impact. Well, it's not publicly available, the direct impact that Operation Vulindlela has on job creation and on economic growth. While we can see certain outputs, such as 500 billion rand of investment being unlocked during phase 1. You can see the year that the unemployment rate from the time that Operation Vulindlela started to now, it has actually increased. So we are questioning whether these reforms are enough to result in inclusive job-creating economic growth. Thank you.
Thanks very much. SAB, South African Brewery.
Thanks, Chair, for the opportunity to present, and thank you, Chris, as well as SARS, for the feedback to our submission and to our oral presentation a couple of days back. Firstly, I'd like to say I love the thoroughness of the presentation that was put forward, in particular the fact that there has been an extensive annexure added to the whole summation of the presentation. Unfortunately, I do believe that it has become a norm not to technically explain what is going on with excise taxes, in particular as it relates to the budget. It has become, commonality to hear that some of these are tax policy conversations and not budget conversations. And I think insofar as corporate income tax, personal income tax, and VAT have been concerned, there's been an extensive amount of international benchmarking, comparative and historical data that has been used to qualify the changes and why the tax environment is the way it is. But when it comes to excise taxes, it is mostly anecdotal, without really giving more detail in a technical fashion as to why things have transpired, at least in the budget, the way that they have. In particular, I'd like to ask the National Treasury team on the excise taxes, has there been a historical trend of there being diminishing marginal returns from the excise tax over time due to the continuous above inflation increases on average in excise taxes? There have been quite a few number of instances where this has been in line with inflation, but on average, this has been above inflation. Is there a perception that into perpetuity, you can increase excise taxes above inflation? And what is substantiating this position? I would have loved to have seen some sort of historical trend in that regard in the annexure to guide the continued position from National Treasury in this regard, since it is a policy position given in this feedback. Secondly, I would like to understand what guides a 2% versus a 2.6% versus a 1% versus a 0.5% increase above inflation? How is that determined? Is it tax buoyancies? Is it the macroeconomic environment? Is it the nature of the average retail prices of the alcohol market? I know that this is a technical exercise, but it's not really coming through in the feedback. How do we know that next year the rate won't be 1.5% above inflation? And why in 2008 was it 3% above inflation? Given that currently the macroeconomic environment is quite muted, what was the reasoning for it to be 2.6% above projected inflation, even though it's winding down? So I would really love to hear some of the technical aspects related to the excise tax, the use of it in this budget in particular, this iteration versus what it was used in the previous iteration. I know that budget one wasn't tabled because of the VAT being an issue, but I do think it's important to note that at that time, the excise rate put in that budget that wasn't tabled was 6.83, and then in budget 2.0 it came down to 6.75, closer to projected inflation. But then in budget 3.0 it didn't wind down closer to projected inflation, it was kept at a higher rate. Is there a technical reason to that, or is it merely in line with the principled position? I think it would be great to see some of that come through, at least in the excise taxes space, because it is really a technical exercise as much as it is a considered instrument for raising revenue and dealing with the negative externalities arising from the harmful consumption of alcohol. Thanks, Chair.
Thanks very much, SAB. Can I ask Pax Kosaju?
Okay. No, thanks, Chair. And, yeah, morning, Chair, members, and colleagues. I think just thanks for the feedback from Treasury. And Chair, we do appreciate these are ongoing discussions. We're not going to resolve our, serious socioeconomic, fiscal, governance challenges in one session. Chair, I think we must appreciate that, Treasury, government, heated society, heated Parliament, to reverse the VAT hike. I think it's a positive, albeit messy moment, but it's a positive signal of our democratic journey. So I think, Chair, really opens up a space for a broader discussion about what we need to do around expenditure side, around revenue side. But I think, Chair, I want to appreciate the fiscal constraints. But I think, Chair, to have a non-adjustment for the PIT tax brackets for a second year in a row, that's beginning to squeeze workers. We don't think we can continue on that front. And so we really hope that, that'll be the end of not adjusting PIT, especially for the lower and middle income tax brackets. We had hoped we could have extended the fuel relief for another year, because that gives valuable assistance to the economy, to commuters. Chair, I think on the expenditure side, there's many positive things, under difficult circumstances. There's above inflation increases to some of the critical frontline departments like education or health. We have seen some increases towards filling vacancies, 800 doctors, I think 4,000 police, 4,500 health workers, 5,500 teachers. But we had seen a bit of a decrease in the first two drafts of the budget on that front. And given the levels of vacancies in many frontline departments, we don't think it's enough. We really need to have a discussion about how can we begin to reverse the brain drain and the loss of skilled public servants. And the huge ratio which has been rising of skilled public servants like teachers to learners, etc. Chair, the infrastructure allocation is quite positive. We hope that's going to really be spent, and there's really a critical need for Parliament also to kind of hold key government institutions to account around it. We don't want to see kind of rollovers or monies returned unspent. Chair, we do think there is a space for discussion with the development of finance institutions, be it the DBSA, IDC, or the PIC, to see how can they also play their contribution towards investing in some of the economic infrastructure projects to help ease the burden on the state. And similarly, with regards to public employment programs, we need to really expand these. And again, how can the DFIs, the CETAs, the NSF also play their role in contributing towards those programs to, again, ease the burden on the state? Chair, I think we were disappointed. We really didn't see much new in the budget or the response. But what are we going to do to fix local government? I think on any indicator, it's in serious trouble. Rural areas, the cities, and we don't really see what is changing to turn things around. We have seen some progress in the SOEs, and I think we hope that the allocation for the post office will now be honored. But again, Chair, we've had a lot of discussions, albeit on messy circumstances around crime. We don't think we're really doing enough to reinforce our law enforcement institutions. Yes, additional police, additional prosecutors is important, but we need to do, I think, much more given the severity of the crises. Chair, the social grants, we really must appreciate double inflation increase for social grants. But again, Chair, we can't understand why could not give the SOD grants a simple inflation adjustment. In the 5 years it's been here, only once has it been adjusted for inflation. That means it's seriously been eroded. Chair, just kind of going forward, we think we need to have maybe three broad discussions. One is about really how to ramp up investments in industrialization, export sectors, and SMEs, because the amount of monies we're putting together are not enough to turn things around. That includes how to mobilize private finance, similarly how to expand public employment programs. Chair, we think that SARS has done excellent work and we want to appreciate the additional allocations. And it might be useful to even have monthly engagement with SARS to see how far they're in terms of dealing with improving tax compliance, dealing with tax evasion, because that really is going to be the engine of our turnaround in terms of fixing the state. Then I think lastly, Chair, look, there are good things in the budget, there are things which worry us, but by the budget's own admission, we'll only see 1.6% GDP growth over the MTEF. So that's half of what we need to get to. So we need to do things differently. And we think, Chair, it might be useful, strategic for the two finance committees with Treasury to almost facilitate some sort of a national dialogue beyond the public hearings here to say, as society, what are the expenditure priorities we must have? What are the things we can afford to live without or defer? And what are the acceptable and also the unacceptable revenue streams to fund these? Maybe we have this dialogue up until the MTBS, Treasury present, a variety of options in the MTBS, and then allow a bit more of a kind of public input so that come February next year, we have a much more inclusive approach, and maybe also hopefully a bit of a social compact approach, but a much more progressive and aggressive budget given our circumstances. But let me stop there, Chair. Thanks for indulging us. Thanks, Chair.
Thanks very much, Kosatu. Economic Freedom Fighters.
Good morning, Chairperson and members of the committees, and thank you very much for the opportunity. Firstly, let me acknowledge the presentation by the National Treasury in their effort to respond to all the public submissions. Just three quick comments, Chair. Firstly, one of the things that does not help the National Treasury in doing their work, and we've seen this in the past 10 years, is that the nature of consultation that they do or hold when they engage in their draft discussion document or any other policy document is that they are likely to sit in a room with everyone else they agree with. And that is not productive, it's counterproductive, because you are likely to formulate your view, thoughts, and policy in agreement with each other, and it's problematic. What is even more concerning lately is that you would have thought Labour in the room would be the one to give a differing voice in trying to bring to the table the conditions and the difficulties that workers are facing. But seemingly like that is disappearing as a strong voice, and it's concerning. But 2 points that deals with the budget itself. Firstly, and perhaps the Treasury not able to respond adequately to this, we may have to go to the committee to attend to this when we finalize the report. The issue that the EFF is raising, twofold. One, what led to the full levy relief in the past 3 budgets has not changed. The conditions are still the same. The high levels of unemployment, the stagnation in economic growth, and much of the post-COVID conditions have left this drag of difficulties that the money that you have in your pocket today is likely to be far less than what you had before COVID, despite the number of inflation cooling down. So that is concerning. But secondly, we're saying, Chair, given the nature of what has happened with the second budget and the challenges and the uncertainty that was brought to the budget by those challenges, we should collectively try and make an effort perhaps to move away from anything that could delay this process, given that very soon we'll have to have the budget finalized. And the way the Treasury is responding in their slide number 18, we're of the view that is not adequate, and it will then lead to a situation where we will have this uncertainty unless the committee take a decisive intervention and say, let's pass this budget without the fuel levy adjustment, keep it where it is now, until such time that there's clarity in terms of is the National Treasury, the Minister of Finance, are doing it correctly by trying to adjust the fuel levy through a government gazette notice. Because should the court find differently that the National Treasury and the Minister don't have the powers to impose general taxation without a money bill, then we're going to have difficulties in future. And we may agree or disagree with the principle that these fuel levies must be in line with inflation. That's such a technical, minute issue. But the important point is that you are imposing a taxation on the general population. And we've learned now with the VAT case that you shouldn't do that unless Parliament has passed the bill. Whether it's interim or not, the National Treasury and the Minister of Finance and Executive don't have those powers, chairperson and members of the committee. And then I'll move to the last point regarding the nature of government spending as a consolidated item. And I agree with the previous speaker about the absence of trying to do something about the state of local government. And we're saying that there is an opportunity, members to could go to the fiscal framework and the revenue proposals as tabled and make an amendment to respond to what could be immediate in local government and which we think could help in resolving some of the capacity challenges, particularly in sourcing of municipal workers in critical and recurring functions, which if we were to plug people full-time and eliminate the tendering of things like security, cleaners, gardening, there could be some avenue for municipalities to recoup some of the money that get lost in the tendering process and the system. So those are the inputs, and thank you very much for the opportunity, Chair, and the members. We really appreciate the engagements.
Thank you, economic freedom fighters. Honorable members, that is the comments from the public. I just want to check if my honorable members are still with me in this meeting. If maybe you can just scream and say hello, then so that I can go to number 4.
Hello, Chair. I'm not going to scream
You're here,
it.
Chair.
But hello.
You're here.
Yes, Chair. We are listening to you.
Yes.
Molo Salo.
Oh, yes.
Buyabenyati.
Yeah. Bunga.
German Kadamanyana, eh?
TG.
Hey, Mount One.
That was a 5 minutes break. And TG is happy that because now they've presented the economic freedom fighters. Before I give honorable members chance to ask questions, let me now give an opportunity to the PBO, Dr. Janji.
Good morning, Honorable Chair. I want to bring my director's apologies. We're presenting as well today to the Standing Committee on Appropriations. So I'm the only person on this in this meeting from our office, and I'll be speaking on behalf of the PBO. So I extend apologies also from other PBO members, and as I said, the director. Honorable members, members of the public and the organizations here, we really appreciate this opportunity, and that it's actually been specifically put on the agenda that the PBO will be given a chance to respond to the National Treasury. There have been issues in the past where we have responded, so we really appreciate that recognition and the opportunity. I want to start off with saying that we've really also appreciate the inputs and the responses today from the other organizations. I think what we're hearing from the consumer goods industries, the poultry industry association, and others is sort of how the extent to which poverty and inequality and unemployment is hurting the South African people, not only the people who are struggling to feed their children and whose children are suffering from malnutrition and stunting, but also the economy as a whole, and this need to actually look at the role of the state and the government in full and the budgeting process within that, and particularly from the kind of what we call the demand side. And when we use that kind of macroeconomic term of aggregate demand, we're actually talking about the whole economy and the people who can buy things, and what that then, how that then impacts on the rest of the economy, our investment levels, etc. I also want to say that I joined the PBO in 2016, and since I joined, I think we've asked almost every year in response to the MTPPS and the budget, the question of where is growth going to come from, and I think there was a response about Operation Vulindlela and the new phases of it. But honestly, in assessing those documents and looking at what has happened, particularly since the end of the global financial crisis, the adoption of fiscal consolidation and the sort of doubling down on the austerity-mindedness of the approach of the budgeting process, I think we have to really rethink, what we're saying. And listening to some of the inputs from National Treasury today made me think about the unfortunate meeting between our Honorable President and the President of the USA, and how words can mean so many different things to different people, and how fake news and those kind of things they are as well.
Dr. Janji? Dr. Janji?
Sorry, I saw.
We have received your apology. Can you please allow Mr. Mohammed to present?
Okay, may I continue?
Can you continue?
Thank you. So I just wanted to say that this is another issue we've been raising, that the approaches being taken and what's being presented as objective and fiscal-based evidence is not to say that people aren't being honest and presenting views, but that different definitions, different ways of looking at the world, different approaches to economics are really important. And so my concern is that a lot of the approach that National Treasury is taking is quite a narrow, mainstream macroeconomic approach, and that there are other approaches to consider, and they should seriously look at those, but also to think about the reality of South Africa and development economics and the kind of developmental approaches that will be needed. And then words like stability, progressiveness, sustainability take on different meanings, and we think whether this kind of fiscal consolidation approach to the dealing with debt is actually going to, in the long run, create macroeconomic stability and stability in debt levels, given the reality of the South African economy and the kind of concerns we saw coming from the Poultry Association and the consumer goods groups and those kind of things. I think we need to actually take the reality of unemployment, poverty, and inequality much more seriously, and to be careful of macroeconomic models and approaches that sort of, in its most basic level, assume that markets work perfectly and that we have full employment. So that's the first point I wanted to make with regard to these approaches, and linked to that is that I'm really worried that if we continue with this fiscal policy framework approach, we actually are going to cause risks to government fund, public finances and government budgets and may see government having to spend more in the future rather than less. So that what seems like short-term stability will affect growth and the possibilities for development. And the other point I want to make is that, progressive development economists will want governments of developing countries, will warn governments of developing countries that while we are developing, we should seriously consider what the role of deficits are, and that it may be important to run deficits, particularly when there are investments in society and the economy that are going to have very high returns, socioeconomic returns, but also economic returns. And so and I think South Africa, in a very targeted way, we can deal with the malnutrition problems, the education problems, notwithstanding the problems we identify within governments and service delivery and other things, but also we can invest in more in infrastructure more effectively, and also more in supporting industry and diversification, particularly of the productive sector. And if we are running a deficit to do so, we can show the huge returns. So I remember in one of the public hearings, one of the presenters spoke about the cost of stunting of children under 5 to the economy, the long-term development problems that causes for the person, but also the overall economic outcomes. And those are sort of in mainstream economics, those are spoken about as externalities, but in real terms, those are the kind of things that are going to come back and bite us if we and increase the risks to overall societal stability, but economic stability, macro stability, and fiscal stability. So that was the one point I wanted to make. The other point is that in talking about this, we see that the fiscal framework presents a particularly narrow macro perspective that can be seen almost as anti-developmental and harmful then. That we have to seriously take into account South Africa's reality when we define these terms such as macro sustainability, etc. I wanted to make a comment about the taxes. And again, I think these issues of definition and what we mean by progressive and what we mean by efficient have to be taken into account. I think we really need to think about the South African tax system as a whole, the different components of it, the balances of it, how much we have in CIT, PIT, etc. And within a broader developmental perspective that promotes economic development, that promotes investment in productive sectors, particularly. I think we need to differentiate between services sectors that support productive activity and manufacturing and other industries, and services sectors that don't, services sectors that end up being extractive, extracting rents, etc. But also take into account the structure of the economy, how concentrated it is, and also then take into account the extreme, what Gabriel Palmer, who developed the Palmer ratio of inequality, calls obscene inequality in South Africa. And I think when we talk about increasing taxes and things like wealth taxes, the middle class particularly are scared that they're going to bear a larger part of the burden. And I think what we're seeing in the South African tax system at the moment is that a lot of without taking into account the high levels, the extreme levels of inequality in the economy, is that a lot of the burden is being put on the middle class, and there's inadequate redistribution to the lower levels of the working class and earners and unemployed people and people suffering from poverty and poverty in the economy. And so I think we really need to look at the top 1% or the top 0.5%. And there's really good work in terms of looking at how the tax system can become more developmental and be used for redistributive measures, and in that process support economic growth and development rather than perpetuate the levels of inequality. And so we really need to look at how we increase taxation on the upper parts of the population, but also when we're talking about CIT, secondary taxes on companies, taxes on finance, taxes on luxury properties, those kind of things we also need to include in our considerations. The last issue, I know I've taken up quite a bit of my time already, is on the SRD, and I think we share some of the concerns that the approach being taken to verify people for grants and not only the SRD but other grants is going to force fewer people to get those, a situation where fewer people get those, and that's in the South African economy at the moment. Take into account the reality, and I think, as we can see, take into account from the people selling consumer goods to South Africans, that's something we really have to take seriously. But also, I think we've learned a lesson from the 2002 debates on the basic income grant, and that I think it's a mistake to link active labor market policies to a basic income grant or a social relief of distress grants and other grants. We need to see them as maybe complementary things to do in the economy. I agree that there should be active labor market policies, but given the levels of structural unemployment in South Africa, I think we may end up in a situation where we're putting too much pressure on what we want to achieve with the social relief of distress grant and hopefully one day the basic income grant. Thank you very much for the time, Honorable Chair. I don't know if there's time left. I don't know if Professor Jantjies wants to come in, if you will allow. I think his meeting, the other meeting may have ended early. Thank you very much.
Thanks very much, Mr. Mohammed. Doctor, are you on the platform? Dr. Jantjies? Okay, I think it's not. And Dr. Mangweni, can you confirm the availability of FFC, or they are not on the platform?
Chair, no, they are not in the platform, Chairperson.
They are not in the platform. Okay, thanks very much. I think now is the time for our honorable members for the questions, clarity. Honorable Van Rooyen.
Thank you, Honorable Chair, and a very good morning to all who are in attendance. Maybe without any waste of time, Chair, I just wanted to check in as far as this process is concerned, Chair, because I hear National Treasury saying inputs will be considered in the upcoming budget cycle. My understanding was that the submissions made in public hearings are relevant for this budgeting cycle. So I'm not sure, does that mean, because listening to their response, what came out very sharply is acknowledgement and, of course, justification of why most of the submissions were not accommodated in what they are proposing. And what I missed is how many of the submissions made were incorporated in their proposal after the public hearings. Not unless my understanding of the process might be incorrect, because my expectation was that most of the inputs will be accommodated in this budgeting cycle. That's my first point of clarity, you know. But well, I think a lot of things, Chair, is the same things that we have been saying about how National Treasury is handling this whole budgeting process. I don't know if it will help for me to reiterate what we have said, but truly speaking, from where I'm seated, all the presenters have came out very, very clear on their opposition to the fuel levy. Of course, we're expecting structures like COSATU to be more vocal on this proposal on the increase on the fuel levy because of its adverse effect on the working class. But of course, we heard only one sentence or so on it. I'm not sure why, but after hearing all the presentation, no one has came up with a different view. And still, National Treasury in its response doesn't see any rationale of relooking at this particular regressive proposal, So it still goes back to that old question that we posed as MK as to who was exactly National Treasury listening to. If public hearings outcomes are so overwhelming on a certain position, what makes it difficult for National Treasury to prioritize relooking at the proposal that they have made to the public based on the overwhelming submissions that have been received from the public hearings? If really the world and the country and South Africans are to believe that National Treasury is a responsive ministry, why? What more will it take them? To agree with the masses of our people that fuel levy is extreme. In fact, is more aggressive than VAT. So it doesn't make sense for you to acknowledge the reversal of the decisions on VAT, but not to be also vocal. In fact, here the country should be roaring. There should be a thunderous, response against this proposal. But anyway, what shall we say if leaders of Labour are also very thin on their condemnation of this regressive proposal? Lastly, Chair, the Operation Vulindlela story, it's a very painful one. Because we have tried as MK Party to analyze the impact of the first phase. Of course, we analyzed this whole thing, relating it to what was its target. Its target was to grow the economy, but also to create jobs. But we all know, without going into technical details, we all know that we haven't seen, in its existence at least, we haven't seen any improvement on economic growth as well as job creation. Instead, we have seen the opposite. Economic growth has declined. Job creations, the latest statistics are confirming, are also going south. So truly speaking, besides hearing opportunities that are being created for private sector, we are not necessarily opposed to that. But the reality of the matter is that Operation Vulindlela seems to be missing its target. And it's difficult for us as MK Party to be optimistic even on the second phase of it. In fact, we are more worried because to us, it seems as if privatization is more on privatization and at the expense of building capacity of the so-called developmental state, And, we should all be worried if that is the approach, because at the end of the day, it means because of the participation, over-reliance on the private sector, over-reliance. I'm not saying there's nothing wrong with working with the private sector, but the private sector can't set the tone in a developmental state. The tone must be set by the state, because if we don't do that, we are making consumers, or we are making the masses of our people to be vulnerable to price hikes or very, very high tariffs for public services and goods, and then we'll be failing in our mandate as the government of the day. So I'm not sure if National Treasury is considerate of such unintended consequences, because it seems to be more, the approach seems to be more reliant on the private sector at the expense of capacitating the developmental state. I think, Chair, those are my few comments, but most of the things, of course, we'll ventilate on them as we approach the committee moment. Thank you very much, Chair.
Thanks, Honorable Van Rijn, Honorable Brett.
Thank you, Honorable Chair. Good morning to everybody present on this platform. First of all, I want to thank all the presenters for the contributions this morning to this committee. There are a few issues that I wish to highlight. First instance, the budget deficit, outlining practical steps taken by Treasury to keep to the commitment to speak to the debt GDP ratio in this year is imperative, especially bearing in mind existing debt that will mature and become payable in immediate outer years. Now, as we all know, markets react to certainty, and credit ratings are focused on our ability to keep to and implement decisive debt reduction measures. Therefore, I welcome Treasury's remark that redeemed debt should not be used to finance future deficits. Budget deficits should be prevented and not refinanced. On the tax system, we've heard calls for increased taxes on corporations, the wealthy, and individuals. Now, all that I want to say in this regard is that you cannot tax yourself into prosperity, and you will surely run out of other people's money to spend if you intentionally kill the goose with the golden eggs. The best form of a general social grant remains salaried employment, which should remain our main objective. Spreading the tax burden and not overburdening a few is a sound economic principle. Then on illicit cigarettes, I thank both SARS and Treasury for taking my previous comments into account. I again stressed my previous point that 79 billion rand in taxes are lost by the mere existence of illicit practice. I again hope that the extra money allocated to SARS will go a long way to make a significant dent in the operations of illegal operators. And I will watch closely this space in anticipation. And I can assure you, I will hold you to account. Then on the ghost employee audit, this is low-hanging fruit. It is a low-hanging fruit in countering the high wage bill. It will also go a far way to sniff out corrupt officials and corrupt practices. But the timeline and the expected finalization date for this audit is imperative. Treasury should not only be seen to be serious and very active to prioritize and finalize this audit. And then in closing, Madam Chair, unintended consequences of Budget 3.0 to our ailing economy and the effect of this budget on the economy is our primary concern, and all avenues to grow the economy must be explored. Thank you, Honourable Chair.
Honourable Maude.
Thank you very much, Chair. Chair, greetings to the colleagues and everybody on the platform. I first want to start by acknowledging the response from Treasury that the notice is still not out and that they are working on it. The time now is 11:50, and it's precisely the reason why we had to seek legal intervention from court because of things like this, where we are literally 3 days away from this so-called fuel increase, and the notice is still not out. It's been worked on a speech that happened 2 weeks ago. Anyway, Chair, it's also now obvious that perhaps we must accept that the National Treasury prepares its presentations to speak to bondholders and investors, and not so much to Parliament and to those who make submissions. And if that is not the case, then it may be that they fundamentally misunderstand this process we're busy with, choosing to lecture us on matters we've already demonstrated to be not a question of misunderstanding, but one of fundamental disagreement. We differ, Chair, with National Treasury, and we do so openly and respectfully. And we point out to them the issues where we differ with them. Their growth projections are overly optimistic. If you look at their slide 6 and 7, they insist otherwise, but their assumptions are unrealistic. Chair, we differ with National Treasury on operational vulnerability, both phase 1 and phase 2. Exactly what the name says, it does not open a path for inclusive development. Instead, it opens the door for private companies to profit from strategic public services that should be driven by developmental goals and not the profit motive. So that's a clear sign of privatization. Go to their slide 8 and 9. They do not respond to any of the concerns raised by some of us who are skeptical about Vulindlela. It is now increasingly clear that this is not an economic strategy at all. It is a repurposing of the state to serve the interests of a particular class. Chair, we don't agree with the allocation that National Treasury has given to SARS. It is too low, and there's no reason why the allocation is spread over the medium term. When SARS says to you, if you capacitate me, enable me, I can go and find this extra money that you're looking for, and you are not prioritizing that. And instead, you want to blame the poor for it by imposing a fuel increase on the poor. National Treasury refuses to increase corporate income tax for ideological reasons and not practical ones. Otherwise, we should be convinced otherwise. They oppose the wealth tax because their underlying assumption is that the state must serve those who already have wealth. And in South Africa, those who already have wealth are apartheid beneficiaries in the main. The claim that our tax system is progressive cannot be taken seriously in a country with extreme levels of inequality, poverty, and unemployment, who in the main are the black majority of our people. Comparing South Africa to countries that did not experience apartheid and do not have a racially skewed economy like we do, in which white people continue to benefit from apartheid wealth, is dishonest. We're not being honest to ourselves. Chair, it is clear we have a National Treasury problem in South Africa. Parliament, if it is to act objectively, must begin to ask serious and difficult questions about what is the role of this National Treasury in our political economy. The National Treasury has ignored all other proposals made, including proposals for a fiscal stimulus in light of the economic crisis. Instead of assisting this committee on how to make the certain amendments of what they proposed, given public submissions, they've given us presentation that explains concepts most people already understand, but reject. And they come here to justify why they've arrived at where they've arrived, even after all of us attempted to convince them to rethink their strategy. They simply refused. So, Chair, I've got a few questions to ask to National Treasury. If the fuel levy were not applied to a zero-rated product, would that not amount to double taxation? Beyond citing nominal figures, does the National Treasury have comparative international studies on the zero rating of fuel levies to support its claim that it benefits the poor and the working class? If yes, can those studies be shared? On slide number 5, Does the National Treasury see state-owned entities playing a greater role in industrial development rather than just investing in so-called growth-enhancing public infrastructure, which is now becoming clear that there is nothing that is going to come from entrusting such a responsibility to private sector? Question number 3, is it the long-term strategy of National Treasury to shut down SOEs? If not, what is their purpose if they are not given support? Every time they get a little cent, we're told it's bailout. But the same language is not used when it's money for other departments. So is the National Treasury of the view that issues of instability and corruption in SOE management have been resolved? If so, would this not be the time to rebuild SOE capacity rather than insisting on privatization? Given the current economic conditions, are we not in a crisis severe enough to warrant a stimulus package? And have you not learned from the previous budget where there was a stimulus package given in the fiscal framework that assisted this economy to grow? Have we not learned anything from that? Or have you not learned from this fiscal consolidation that we've been doing over 12 years that has not resulted in anything tangible? That's why we're sitting in a country where there's high levels of unemployment, poverty, and inequality. Chair, on slide 22, if compensation of employees, goods and services, and capital assets allocations are consistently declining and projected to decline further over the medium term, is this not an indication that the role of government will shrink? Is really National Treasury not thinking that this is really shrinking the role of government? Chair, the last question to National Treasury is, can the National Treasury explain if this concept of provisional allocation is an attempt to introduce a hybrid zero budgeting or a way of phasing in zero budgeting? And I've got one question to SARS, Chair, just one. Can SARS give us in writing, even if it's in the next 3 days, before we consider the final report of what they can do possibly with 4 billion rands allocated in 2025-26 in terms of multiplier and how much they can possibly collect compared to the 4 billion rands allocated over the medium term? Chair, that will be all from my side. I thank you for your time.
Thanks, Honorable Maote. Honorable Sibisa.
No, thank you, Chair. And let me also greet my colleagues and everybody that's on the platform. Also, welcome the presentation and even though we are not satisfied with the response from National Treasury, Chair, it's a concern. Because I believe if somebody gives you 5 reasons as to why they cannot do something, it means that they do not want to do that. And I thought that since National Treasury is here today, they will tell us from the submissions that have been made by all the stakeholders, even the public, we've opted for the following, but none of those have been implemented, Chair. For the mere fact that National Treasury says that their bulk of the budget is from the PIT, or personal income tax. Now, Chair, I'm going to go to slide 17 of the presentation of National Treasury, whereby they are coming with options and they're giving us reasons why they cannot do away with the fuel levy. And then they come up with options, especially when you go to bullet number 6. How do you explain to Mr. Ngobo, who's staying in a rural area, that he must go and buy a hydroelectric car or must move away from using fuel? Because we are not only speaking about cars here, Chairperson, we are speaking about trucks that are going to deliver the food. I thought that National Treasury will touch on the issue that was raised. And this is a question that I also posed to say, how is fuel levy going to impact the food prices out there? I thought that they would touch on that, but they didn't touch, because I would agree with what TJ is saying. Somewhere we are going to tax the most vulnerable people in South Africa backdoor. Because the moment you take the fuel levy up, then it means that food prices are going to go up. So they should have given us an option. And what guarantee do we have, Chair, that as we go on with these discussions, that there is actually going to be a change to the fiscal framework? We don't have any guarantee about that. Rather, we are being given justification as to why we are doing what we are doing. So it raises a question of why are we having public hearings? If anything that is going to be said by the public is not going to be taken into consideration. So why are we just ticking the boxes to say that we've done this, but at the end of the day, we are going to do what we said we are going to do from the onset? So why are we having public hearings to hear the opinion, and then National Treasury is not prepared to make any changes to their fiscal framework, rather trying to come here and give reasons as to why we cannot do what we are doing? And I'm also going to agree with the TG to say that you can't compare South Africa with other countries. You cannot. We can't find ourselves there. So I want to pose a question to National Treasury to explain, in simple words, explain to a South African that is not an economist, explain to a person who's sitting at home, who is unemployed, who's relying on certain things for an income, unemployed, they're relying on their own to say that there must be food on the table. How do we sell fuel to neighboring countries, and those neighboring countries sell to their residents at a lower price, and yet Tina, the wholesale, is selling the same fuel to the South Africans, and we are on the brink of actually applying the fuel levy? Explain to a person in lame English or in simple English, how does Botswana sell fuel at a lower price, whereas Botswana is buying fuel from South Africa? In simple English, Chair, then maybe those people will be able to understand, because we need to take into consideration that South Africa is at 32% unemployment rate, most of those people being the young and the graduates. So how do we sell fuel to the neighboring country, and yet those neighboring countries are selling fuel at a lower price for their residents in their consecutive states? Thank you, Chair.
Thanks, Honorable Sibisa. Honorable Besley. Honorable Besley.
Sorry, Chair, I didn't know it was me up. So, yeah, my whole thing comes around the road accident fund. You know, again, I come back to the point that I believe it's totally nonsensical. You know, to raise 4 billion on a 2 trillion budget. So, you know, I'd just like to know what drove that it wasn't in the previous budgets, and my concern, it's been introduced by somebody, and I'll be quite frank, as the DA deputy minister who drives around in blue lights, gets his fuel paid for him, but it's just for 4 billion. It's just nonsensical. And 2 days ago, I was sitting in the road accident fund. The directors were there, and it's a shambolic. It's a cesspool of corruption and incompetence. They get 50 billion from South African taxpayers a year. And now we're putting more money on the fuel levy, and we've got an organization of 50 billion, a cesspool of corruption and incompetence. You know, they've had adverse audit opinions. You know, surely we should stop the leakage there before we start charging the poorest of poor South Africans more for fuel. It's absolutely nonsensical. And to me, it's been introduced by somebody who doesn't have any EQ and doesn't understand the plight of the poor, because clearly if they did, they wouldn't introduce such a regressive measure that's going to benefit the country so little. Thank you, Chair.
Honorable Ryder.
Thank you very much, Chairperson.
Yes, I think Mr. Beasley's attack on the Deputy Minister is highly inappropriate, ill-informed, as have been his past inputs as well. And I think that such an attack should not be countenanced. Expecting that a Deputy Minister is responsible for this budget, solely responsible for the budget, making such allegations is highly inappropriate. So I just wanted to start off with that. Chairperson, thank you for the opportunity, and I want to join a number of the civil society and members of organised business and business in itself in appreciating the level that Treasury has gone to respond to the discussions that we've had already, and I think in a fairly short space of time. Though I think some of these were predictable, but they've come back to us with a good comprehensive response. Spent a lot of time covering it this morning, but also in the supplementary forward. So we had a number of people beating their chests earlier on this week about the fact that inputs are not taken into account. We've seen in the past that they have been. I mean, that's where this GFECRA issue came from in the first place. Amendments to the health protections levy and amendments to things like the one escaped my mind now, but those are just three matters that come roll off the tip of my tongue as I sit here. But certainly the inputs that have been given over the last couple of days have informed us well. So thank you to the presenters. But the responses are equally important. And I do want to make the point, and I think Kasatu made the point as well, is that we're not going to resolve complex issues in one cycle. The fact is that the inputs that are given here today will often be affecting or influencing the decisions made in the next cycle. So it's a comment I made last year, but I'll repeat it again. Don't feel totally disillusioned if your ideas are not adopted wholeheartedly. Chip away over time, and you will find the impact of your work having effect over a multi-year period. Good. Thank you, Chair. And then I want to move on to some of the comments that came out today from the responses. I think that the comment about reducing the complexity of triple Ps, the importance of triple Ps, firstly, I want to just also emphasize, but reducing the complexity and the issues around a triple P through Treasury is something that we really need to see, because it really has been seen as a barrier to entry. It's been seen as a massive hurdle over a number of years, and just that administrative and the long time frames that are taking place, and of course the degradation of service in the interim while a triple P is being considered. Then suddenly no one wants to take responsibility for something because this beautiful savior is coming over the horizon, and then nothing's achieved. I don't want to say that happens in every instance, but it is obviously a threat, and I do think that the triple P process needs to be massively simplified. So I'd like to see something more concrete about that. Interesting about the fact that there was a court case in 2021 about dairy liquid beverages, which was not mentioned in the first round. But I do think that perhaps it's worth reiterating, and a number of the speakers today have spoken again about the zero-rated goods. Treasury dangled this thing out there in iterations 1 and 2, and when Budget 3.0 arrived, suddenly it had gone. And I think that on people's projections, on people's capital expenditure, etc. And I do think we need to take that into account. And I do think that reviewing of the zero-rated goods remains an incredibly important thing. And it's been indicated already, the revenue foregone will not be substantial, but the difference to people that are struggling to put food on the table, I think, is important. Yeah, the 0 rating was it. Ring fencing, I think ring fencing is important, and it was raised as well. I think Saker brought it up today. The fact that certain taxes really should be ring fenced. Health promotions levy is probably one of them. But the fact that softening the blow of the fuel levy increase, spending some of that fuel levy on the things that it was intended to fund. So the fixing of our roads, I think, would be something that would be greatly appreciated by the majority of South Africans. Chairperson, yeah, I'll leave it at that. I think it's been good, constructive engagements. I think our staff have a tremendously difficult job in encapsulating all of these inputs into the report. I look forward to receiving that report as promptly as possible. But yes, thank you very much indeed for the chance.
Thanks, Chair of Chairs, Honorable Squati.
Thanks, Chair, and thanks to the National Treasury for their responses, but also for various stakeholders in terms of raising the issues that they felt needed to be raised. But Chair, I think one of the things that we need to really take into account, it's the difficult economic conditions that we're faced with, but also the complex geopolitical terrain that we have to really address or work within, in the sense that I understand there is a need to make difficult trade-offs, and which is very, very much important that we are dealing with this.
Question about non-selling of posts.
Dr. Janji. Dr. Janjis, please stop disturbing my meeting. Honorable Squati, can you continue, please? Honorable Squati?
Yes.
Can you
Thanks.
continue, please? Thank you.
Okay, thank you. I was saying, Chair, we need to really consider the fact that we are not operating under an ideal situation, and therefore we need to make difficult trade-offs, and these trade-offs need to really be implemented. And Chair, one of the things that we haven't really dealt with is the question that I think POB has also asked, in terms of where exactly is the growth going to be coming from? Because honestly, Operation Vulindlela is creating an enabling environment for those ailing sectors, for those areas where we had, gaps, but also where in the past, we have actually lost some form of revenues and so on. So we are trying to plug those holes so that we continue to rebuild the capacity of some of those agencies, but also some of the sectors. However, that does not necessarily mean that that is going to grow the economy. Yes, it will work towards creating or growing that potential or unleashing the potential that is there, which we are not able to recover because of the stumbling blocks or whatever blockages that were there. But it's not necessarily going to grow the economy. And I think one of the things that we need to do, which unfortunately is also not Treasury alone to deal with, is to identify those potential sectors that will immediately be able to give us growth. Whether it's in agriculture, whether it's I wouldn't say manufacturing because we have been declining, And you can see that a lot of factories are also continuing to close and so on and so on. And yet we're talking about economic growth, we're talking about all this, revenue that we must create and so on. Because even SARS at some point will run short of, revenue streams if the economy is not necessarily growing and is continuing to shrink and industries are closing. So we need to really find our mark antenna. Where is this growth going to come from? Because unless we do that, we are going to put SARS in under tremendous pressure. Because now we are saying, SARS SARS has identified those areas where they believe that there will be. But remember, it's working on an assumption. So it's not really something that we can think that it might be a silver bullet for the challenges that we are having. And until such time that we are able to identify that, a growth point, that will be able to assist us. Because over the MTEF, we're still going to find ourselves in perhaps even worse challenges that we have. I mean, all these assumptions of economic growth might actually be eroded by other challenges that might arise. As long as we are not able to find a way of dealing with the sectors that can give us the growth that is actually enabling us to have a better and healthy economy. And I think one of the issues, Chair, that the stakeholders have been raising, it's that there is a need for consultation with the industries, which I think is a very valid point, because this is the sectors that can actually say to us, these are the areas of us for us to be able to expand, for us to be able to create more jobs, for us to be able to do more in terms of creating more opportunities. This is what we need to be doing, which can actually even be bigger than the excise duties that we are actually getting from, these sectors. Because then if you grow the economy, everyone will be able to find a better way of, taking care of themselves and so on. So I'm just saying, perhaps we need a bigger discussion. Like somebody has actually suggested that perhaps we need, I think it's Kosatu that said, perhaps we need to have a dialogue, because the issue of economic growth, honestly, it's one of the things that we really need to focus on, so that we do not necessarily put SARS and Treasury, because Treasury doesn't grow the economy. Treasury allocate the resources that have been generated from the revenue. So we need to find, because otherwise we are limited to tax streams if the economy is not growing. And as well, it's going to shrink, because all those streams that we're talking about, if all these sectors or the industries that we are getting excise duties from and we are getting, they'll also get depressed and some will close down and so on. So I'm just saying, let's find that, way of dealing with the dialogue, particularly in terms of economic growth, and move a bit away from, the taxation or over taxation might not necessarily sustain the programs that are so much progressive that we need so much in the future. So we need to find a better way of dealing with that. And the last one, Chair, is the issue of efficiency and the capacity of the state. I think that is one of the major areas as well that we needed to be dealing with as we are dealing with the economic growth and other interventions. Because as long as there is no efficiency in terms of utilization of these allocated resources, and there is no accountability, we will continue to have shortage of fiscals. There is no way that we'll be able to grow. There is no way that we'll be able to provide services as long as there is no efficiency and the capacity of the state is not necessarily taken into account. there is no accountability, but also we continue to have, human resources that do not have the required capabilities of providing the services that are actually required. Because I think as long as we don't have those, we will continue to have this kind of fiscal challenges. And I think we need to really find a way of dealing with this challenge in a manner that would show us that indeed we are aware that we are dealing with a fast moving target. Because all these remedies that we think we have found today, tomorrow they will not be, enough to or appropriate to deal with the challenges that we are having with the economic growth declining, with population growing, with high unemployment rate. We might not necessarily be able to deal with them until such time that we are also able to deal with this leakage in terms that is created by the efficiency within our government and the state. Thank you, Chair.
Thanks very much, honorable members. I don't see any more hands here. So I'm going to allow the National Treasury to respond and also SARS if there's any. I don't remember any member asking something about SARS, but I think that will be also from them to see which ones can they respond to. Can I request the National Treasury?
Thank you, Chair, honorable members and stakeholders for your interventions. Chair, with your permission, we have received quite a lengthy list of questions and interventions, so I will request that the team respond in turn, which might take us a while. I will, in the interest of time, already indicate which members of the team will be responding and in what order to try to save us some time in that regard. So I'll first ask Chris to respond to the many questions that we received on tax policy, including zero rating the progressivity of the tax system and the fuel levy, among others. I'll then ask Marumo Nketa, who is the Chief Director of Fiscal Policy, to speak to questions related to the fiscal strategy, along with questions that were raised in relation to infrastructure, as well as debt dynamics and the credibility of the fiscal strategy. I'll then request Ravesh to come in on issues related to the funding strategy, international financial institutions, debt renegotiation, JFECRA, among others. And then I will ask Rendani from Public Finance to speak to us on issues related to the expenditure side, including on the SRD. We had one question on local government, if memory serves, that I'll ask Okhala Lezeng from Intergovernmental Relations to please reflect on, and I will reflect on the few questions that were asked in relation to economic policy. With your permission, if we could please respond in that order, Chair.
Okay.
Thank you very much, honourable members.
In that order.
Thank you very much, honourable members and stakeholders. Maybe I can start with the questions on a zero rating. There are quite a few from the retailers. I mean, just to give our perspective on zero rating, when the VAT rate was increased in 2018, we went through a long parliamentary process to look at additional zero ratings that year. We then had an independent panel. We decided on a few, and the minister announced additional products to be zero rated in 2019. As soon as those products were zero rated and the next committee meeting was held, a large number of the stakeholders said, yes, but this doesn't help affordability. So you actually not help bring lower income households enough. For example, some of the products would decrease in price from 20 Rand to 18 Rand 50. And they were saying, but the products are still too expensive, which is why a large part of the projects at the time were expenditure programs, for example, to get sanitary products into schools that are then provided free in lower income households. And that is part of the issue. The other part is about where does the benefit actually go? So one, it doesn't fix affordability completely, especially for low income households. The other part is where does the benefit go? If you were to zero rate a product and it was going to cost the government 5 billion Rand, Those products that we zero rated in 2019, we show the price changes after the zero rating. You would expect the price to go down by 15%. Instead, the prices went down by between 7 to 8%, about half the amount. So the 5 billion that government is losing, about half of that is going to lower income households and a benefit through lower prices, and the other half is going to either the retailers or the distributors. So if you are going to lose 5 billion, why not spend 5 billion directly on lower income households to assist them, rather than having this leakage that also goes to producers, which is part of the reason we don't agree with it. But we're happy to meet with the Consumer Goods Council for South Africa. We're happy to talk about this and to talk about the evidence and have meetings on this. The current zero-rated basket is well targeted to poor households because a lot of this work was done in 2018 and a few of the additional items were added. So it's not as easy to find additional zero-rated items that would be well targeted. We did do that research. We did do the analysis and the evidence. The products that we had included were the next best along the scale of which products would be best for lower income households. But because of these issues, if there is no VAT rate increase, we don't believe that it is the best course of action to continue with that zero rating. On the progressivity of the tax system, there have been quite a lot of comments on that. I think the chart that was shown by the AIDC, by Willard et al., is basically exactly what we agree with. It shows that we have incredibly high levels of inequality, but our tax and fiscal spending system is more regressive, more progressive than those countries shown in that example. The reduction from the market income, which is before fiscal and tax, that goes then all the way down to post-fiscal and tax, that is the biggest decrease in inequality amongst all those other countries that are surveyed. So our tax and fiscal system is doing much more work than other countries in terms of reducing inequality. But the problem is, and I agree, the problem is inequality even after all of that is still too high. But what can you do to fix that? Can you push the tax and fiscal system more, or do you need to do that through improved economic growth? We think it's very difficult to do it on the tax side. We push tax rates up much higher than other developing economies. We have a high tax system. So what do you need to do to reduce those inequalities further? And I think that's where a lot of the questions that flow through all the discussions we have today need to be focused on. There were points about loopholes and profit shifting. Completely agree with those. We need to close down loopholes. We need to stop profit shifting. We have done a lot of work on the legislative side to close down those loopholes that are created. The legislative wording that is done gets very complicated, but we do that. SARS needs more auditors to check that. Some of the funds that are going to SARS are to try and improve enforcement. So there was a big push about stronger enforcement, which again, we completely agree with. If SARS has the resources to do that, they can do that. We will try and close the loopholes from a legislative and policy side, and then SARS can try to enforce, and that will be a focus. The point about the VAT and general fuel levy also being blunt instruments, they are, but they're very good revenue raising instruments. They're very broad base. You don't need to have such a high rate because it is such a broad base. And as we've spoken about, the overall system is progressive. On the excise duties on alcohol and excise duties, it is another measure that the minister can use to raise revenue. It is looked at in that view and in that light. We are doing this review. The current and previous proposal and the previous excise policy was to try and target a particular weighted average selling price, but that has come out of line, which we've agreed with, which is why we've done a discussion document, and we will have consultations and stakeholder workshops during the year to find a new system. But it is seen as a mechanism that can be used to raise revenue. There were questions about to say, but what about the international comparisons? If you go to page 37 of the discussion document that we published in December, you will see some of the international comparisons. And if you compare us to EU countries, for example, we're about in the middle of the road. There are some with much higher levies on spirit and higher levies on beer. all of those countries do have relatively low levies on wine. We can extend that to other developing economies as well. If you are asking about, well, what about the diminishing returns to excise duties on alcohol? If you go to pages 26 and 27 of that discussion paper where we put the details, you can see that when we do increase revenues, they increase excise duties, there are increases in revenue either that year or the following year. So we do still believe that it is a mechanism to generate additional revenue. And we can have more technical discussions on the excise duties on alcohol through the year. There was a question to ask about timelines and details of implementation. Our plan was always to start those consultations after budget. It has taken a number of months to get through the budget, so we will start those consultations very shortly. The underlying reasons for buoyancy, the two pots revenue was quite a bit higher than we thought. We have had much weaker growth, but the revenue gains have been higher as well, which has led to much higher buoyancy. The buoyancy in the outer years is higher because of tax increases. There were a couple of questions on fuel levy and the ring fencing, and that it should maintain and build roads. If you go to slide 58 of the deck, there is actually a fuel levy sharing arrangement with municipalities. And part of the money that is raised from the fuel levy goes directly to the municipalities. It is not prescribed what the municipalities use it for, but it can be used to maintain and build roads within those municipalities. And there was a point about the wealth tax and evidence for growth. We're happy to share those papers. There was a request to say, well, can't we have a paper on some of the policy ideas of tax, and we can have more discussions such in a similar manner to the fiscal anchors. I think that is a very good idea, and we will consider that as well. There was a part about the nature of consultations and that we only sit in rooms with people we agree with. I would strongly reject that notion. Every discussion paper that we put out, we send invitations to every single person who comments. And any single person who comments on those discussion papers can come into those workshops and have a discussion, and they're free to say what they will, and we could discuss the different policy ideas. I think there were some points about the allocations to SARS. I might leave that to public finance, but we do agree that SARS need more, which is why we provided more to them. The zero rating on the fuel levies. So in the slide deck at the end, we talk about other countries which show that which countries do have, for example, either a general sales tax or a value-added tax, and the levies in those countries are generally higher than the levies that we receive. We can try and provide more analysis there if required, but we do have that comparison at the end. There was a point about, what is this? Why are you talking about moving to electric vehicles in the medium term, and what actual benefit does that have to individuals? So this is part of every instrument that government usually has multiple objectives. The one major objective for the fuel levy is to increase revenues for social expenditure, for grants, for health, for education, etc. But there are other objectives that we try and kill two birds with one stone. Part of that objective is to move to a greener economy, to move away from the use of vehicles to reduce consumption, but to reduce congestion, but also to try and move to new types of vehicles which have a greener footprint and reduce emissions. They might not assist for lower income individuals who don't purchase a car, for example, but if you are, for example, a busing company and you move to a new type of vehicle which isn't as reliant on old fossil fuels, you can reduce emissions as well as providing transport. So we try and meet those multiple objectives. There was a point about the price of the fuel levy on food. I would just like to point out that we have a diesel refund for the agricultural sector. So you get about an 80% diesel refund for the road accident fund levy and the general fuel levy. The other mechanism which we have included in this budget, which is going to cost R1 billion in 2026-27, is that we are expanding that levy for agricultural production on fuel to 100% from 80%. So we're increasing that levy to try and reduce any potential impact on prices. And I think that's all from my side. If I have missed anything, I'm happy to come back in. Thank you, Chair.
Thanks very much, Chris. And can I check if Mr. Mohammed? No. I mean the SARS. Is there any comment that you'll want to comment on?
Hi, Chair. I think National Treasury was still continuing. I see Morumo wanted to say something.
Okay. Thank you. National Treasury. Okay.
Thanks, Honorable Chair. But I don't mind if you wanted to take SARS first, Honorable Chair, and I can
No,
come
it's
up.
fine. No, just finish. I think all the delegation of SARS, I mean the National Treasury, can respond to questions.
Thanks, Honorable Chair. I will try and deal with some of the some of the questions relating to the fiscal strategy. And I'll also ask my colleagues, as the acting DG said, my colleague Keta, and to just deal with some of the issues that I might miss. I think the first question that I want to start with, Honorable Chair, it's around these issues the issue of public hearing and how these public hearing are going to impact on the current budget, and why are we saying as the Treasury that we will take into account some of these comments as and when we craft our future budget. I think, the issues there, or the manner in which these processes are structured, Chair, the processes are structured in such a way that the Minister of Finance first tables a budget in Parliament. And after the minister has tabled a budget, and then the minister comes and briefs the relevant committees. And thereafter, the committees embark on these public hearings, a journey where members of the public and other stakeholders comes and present their inputs. And currently in legislation, there is no provision that after all these processes have been undertaken, the public hearing have been undertaken, there is no provision that allows for the budget to be returned back to the National Treasury to take into account these inputs. Which makes me think that, and this is just me thinking, that it then means that the inputs that the members of the publics are presenting here are the inputs that are meant to help Parliament as and when it processes the budget, taking into account inputs that the colleagues are raising, and helps Parliament to take decision as to whether it will adopt or amend the budget on those based on those inputs. But we are saying from our side that because these inputs are very important, as already indicated, it is indeed, critical that we get different views from other members of the society. And we are saying that because it is important to take into account some of these inputs, we will of course consider them as part of our the next MTF budget processes, so that we then reflect some of these inputs that colleagues are raising. And from our side, we are also, as the presentation has indicated, we are also trying to strengthen our public participation processes. So that as part of the budget process, that we can invite members of the publics to come and present their views. And take into account those views as and when we craft the fiscal framework moving forward. So that is the thinking from our side moving forward. And then there was a question around slide 22 as to whether the decrease in shares of spending in the wage bill, goods and services, and others means that the role of the state is decreased. I think it will depend on how we want to interpret the matter. And as we've indicated, I mean, debt service cost years has increased over the years as a percentage of consolidated spending, which means that the bulk of the monies that we have in expenditure has been going towards servicing the debt. Because over these years, we've pumped up our debt, we've grown our debt stocks to such a level that the servicing of those debt has started to become a problem. And if indeed we continue on this trajectory over time, it will indeed get to a point where the capacity of the state to respond to some of these issues is indeed reduced, especially if you get to a point where debt service costs are taking something close to 30% of your consolidated spending. So it will mean that there wouldn't be any enough money left for government to respond on some of these issues. So how we deal with how we manage the fiscal strategy moving forward is very, very important for debt service cost increasing. And then in terms of there were questions about whether we are confident that the debt will peak in the current financial year, and what are we doing to ensure that it peaks. And we've indicated that, I mean, we are using the primary surplus as our anchor to try and reduce the deficits, budget deficits, which in turn, in our view, it will reduce this debt service cost moving forward, which will start start creating some fiscal space for other items to share budget to increase over time. So we are still confident that we will peak in this year if we continue to maintain our primary balance. But of course, I mean, if we should we decide to abandon that and increase expenditure without any matching revenue, then there will be problems in managing this. Then the issues around, I mean, there was also an issue that was raised around the budget process and whether National Treasury just goes and sits in its own corner and decide on the budget, or sits with the people that it agrees with and decide on the budget. And I must indicate, Honorable Chair, that, I mean, budgeting doesn't necessarily happen at the National Treasury. In fact, budgeting happens at the departmental or at an institutional level. And this department then submit proposals to the Treasury. And during the course of that, I mean, there are a whole lot of consultative engagement or forums, either at an intergovernmental level through what we call the Technical Committee on Finance, which include provincial treasuries as well as the Budget Council, whether it's the 10x10, which is the sector meetings where the various sectors like health and education will come together with the treasuries and present their proposals, and Treasury present the fiscal outlook, and debates ensues in those meetings up until proposals or decisions are taken. And there are other structures in the budget process. I mean, the Technical Committee on the Budget, which is chaired by the DG of the Treasury, as well as the DGs of other various clusters, and the Ministers' Committee on the Budget, which has to take decisions based on those approved proposals that would have been presented by the Technical Committee on the Budget, and subsequently Parliament, I mean, Cabinet, that then approves those proposals. So once the budget is tabled in Parliament, it becomes a Cabinet-approved proposal. So it's not necessarily correct to suggest that National Treasury just sit in its own corner and decide on the budget. And then in terms of the non-interest expenditure as a share of GDP not increasing, and I must indicate that non-interest expenditure in nominal term is increasing, and we indicated by 5.4% on average over the MTF, and in real term it is increasing as well. I think the issues around its share of the GDP, I mean, there will always be those contention, especially if you look at our strategy of trying to rein in the debt and reducing the debt service cost using the primary surplus that has to increase. So there has to be that little bit of balancing that needs to happen with regard to that. Honorable Chair, I will I will leave it there. And I mean, we note the comments that have been made by Honorable Breeds around the issues of ghost workers and the fact that we need to fast track that project. And I can indeed confirm that the project has started. We're doing the technical work, and we'll be able to give some updates during the time of MTPBS, and then the issues around efficiencies and the capacity of the state from Honorable Sukwati. I think we do note those issues as well. And let me allow my colleague Keta to come and deal with any matters that I might have missed, Honorable Chair. Keta.
Thank you, Honorable Chair, and thank you to the colleagues for their inputs. I think, Marumo, you dealt with most of the questions. I just wanted to clarify to the Honorable Member on slide 22, that's a compositional chart. So all the bars are meant to add up to 100%. So you need to read the chart in terms of adding up the bars, and in each year you'll see that it's 100%. Part of the confusion, Chair, is that the budget documents are meant to be read in tandem. So both the budget overview document as well as the budget 2025 document, and looking at the tables, and you'll see that the issue there is that the growth of infrastructure is much faster than the other items. So you will see, obviously, that compositional shift, but it's not necessarily talking about changes to GDP. Marumo's already answered the question about debt servicing costs, and some of that will be reflected by my colleague Ravesh's discussion on the debt stock. But I just wanted to clarify to the colleague that the correct way to look at that is to develop a counterfactual. So the fiscal strategy stabilizes the growth of debt servicing costs, and then over time brings it down. So the counterfactual is what happens if you don't arrest that stabilization in debt servicing costs. I think the PEP has already highlighted the fact that following this year, when debt stabilizes, real spending, real per capita spending is stabilized. So that's in response to the AIDC's point. The Honorable Member asked a question about fiscal stimulus, and maybe I can answer that question in tandem with the question that was asked by the Institute of Economic Justice, which is that our research program, SA Tide, has already done a review on both fiscal multipliers and the question of fiscal stimulus. So I invite the Honorable Member to read those papers, and I think the Honorable Member asked that we make those papers available to them. So we commit to making those papers available. So we've undertaken that work, and the most important thing to understand there is that our fiscal multipliers are low and below 1, and we've reported previously on this in previous budget documents. There was an Honorable Member that asked if we are taking these issues into account in this current fiscal framework. As we said in the upfront slide by the acting DG, that some of these inputs are already reflecting members' inputs from past hearings processes. But what we commit to do, Chair, is that when the report has been ratified by your committee, we will provide detailed responses through our Minister. Thank you, Chair.
Thank you, Keta. Thank you, Honourable Chair. In terms of the questions that were posed by the Honourable Members and the valued stakeholders, just around some of the questions dealing with GFECRA, I think there were a few questions around GFECRA. So just in terms of the impact on the drawdown, so basically we've had a 100 billion drawdown. So the impact, there's been no impact in terms of that drawdown on the financial markets. Obviously there's a further 25 and 25 that needs to be drawn on over this year and the next year. And in terms of the question, I think that was asked by the gentleman from SAICA, in terms, as well from other colleagues, just around the fact that GFECRA has now swelled to an amount of around about 390 billion, and whether we are looking at further drawdowns against that. I think it's important just to highlight to the honourable members and valued stakeholders that there is an agreement that we have with SARB, and what we need to do is obviously that gets updated on a yearly basis. So I think at the time of the MTBBS, we will then make further announcements in that regard. There was a question just talking or just referring, sorry, to the question around debt renegotiations. I think just around this, I think we have to stress that if there's any debt renegotiations from a sovereign perspective, meaning from government, that would then spark a distress signal to the markets, and obviously the rating agencies may then downgrade us. So, which means that we would probably be about to default. So I think that's quite important just to highlight that we don't necessarily go into a renegotiation of our debt, because obviously that will result in significant impact on our debt stock. What then will happen is obviously the rating agencies will downgrade us, and obviously that would have serious repercussions for our borrowing program as well. And obviously, it's also important to highlight that that the debt management team as well, they do obviously go out and issue bonds and raise debt at different curves. At different points on the yield curve. So I think it's important just to highlight that there is obviously that work that's done by the team in terms of looking at the best options that they can get from the markets with the various lenders, multilaterals, and so forth. There was another question from the honourable members and valued stakeholders as well, just around shouldn't we then bring the terms, or have the more in-depth or detailed or comprehensive discussions around how do we deal with some of or raise debt and bring some of the agreements to Parliament. I think it's just maybe important to flag, and I'm just going to just flag in terms of the PFMA, that Section 71 of the PFMA authorizes the minister to borrow money, amongst others, to finance deficits, to refinance maturing debt, and also maintain credit balances of the National Revenue Fund. So payments in terms of loans, are direct charges against the National Revenue Fund. So the borrowing powers of the minister is not necessarily linked to the provision in Section 29 of the PFMA for departments to spend, pending the adoption of the budget or the adoption of the budget itself. So I think we just want to flag that and highlight that to the honourable members and the valued stakeholders. Then I think just turning to the questions around, I suppose just around the broader issues around state-owned companies, around the sustainability of them, and in terms of whether we want to see them closed down. I think it's just important to highlight as well that we have historically have provided bailouts to Eskom, to SAA. I think we've mentioned that before in various budgets in terms of the quantums, and also government guarantees as well, which basically is to ensure the sustainability of the state-owned companies. And obviously, if one looks at the network industries and how an important or significant role Eskom, Transnet, and the water sector plays, I think that's quite significant in terms of the support that we provided. However, what we always implore from the SOCs is to also relook or basically restructure their own businesses to look at how they can also be self-sustainable in terms of restructuring their businesses, looking at disposing of non-core assets. I think that's one of the key messages that we've actually progressed with the state-owned companies, and we've seen significant movement in that regard. But it's not obviously selling off of the whole businesses itself in its entirety, but looking at disposing of non-core assets. If we look at Eskom, they disposed, or in the process of disposing of the Eskom Finance Company, and more recently we've seen the announcement from Transnet in terms of disposing of its non-core property portfolio as well. So I think that's quite a significant departure in in terms of where the SOCs have come from. But again, the certain companies are here to be sustainable, not to close them down, but to ensure that they function in a way that will contribute to the positive outcomes in terms of the operations within LEDA phase 1 and phase 2, and also to improve the and sustain the network industries. I think from my side, I think that's it. I'll hand over to the next speaker. Thank you.
Thanks, Ravesh, and good afternoon, honorable members. It's Rendani here. I will deal with the questions in relation to the SRD and expenditure. Let me start with the issue raised by Saika on the provisional allocation for SRD, the 75 billion in the next 2 outer years. Its confirmation or allocation will be informed by the future of the SRD. At the moment, there is a study being done on ALMPs. Linked to that is the future of SRD. So depending on the decision that gets taken by Cabinet on its future, then it will determine the allocation of that provision. And again, the provisional allocations is not a precursor to zero-based budgeting. Like my colleague indicated, the state of readiness by the department will determine the allocation, and we already have a provision in the appropriation bill, assuming that it passes in its current form. There is a section 6 of the appropriation bill. Institute for Economic Justice, the conditions against the court judgment. Look, we are appealing against that judgment. Like my colleague indicated, that judgment is a fiscal risk on its own. And again, we're looking at the bigger picture here. SRD or social assistance is not the only program that we have. We also have other social assistance programs outside the Department of Social Development. For example, we also have legal aid assistance, military veterans benefits, etc., etc. Hence, as we speak, 61% or so of the budget goes towards a social wage. So there's no way that we can't have a mechanism to filter out undeserving recipients of these social assistance programs. So that's why we're appealing that judgment, because the way it is, if we don't challenge it, it is unavoidable. So there should be a mechanism to filter out undeserving, just like with legal aid assistance and military veterans benefit, because that judgment, it has got implication for those other benefits. On the issue of the capacitation of the state, I want to link it with the question around some of the recommendations not taken into account. If we let me link it with the issue raised by COSATU. I think if we go back to 2021 MTF, 2022, 2023, for example, we've been capacitating the police and the NPA in particular. So what we have done, is it enough? No, it's not enough. We'll continue grappling with these issues of capacitation. There are recommendations to capacitate the front line. I mean, even if we can have funding today, one of the things that we need to consider is the state capacity to spend. For example, the police, their colleges, they can only take a certain number, beyond which they won't be able to absorb the trainees. So these are some of the issues, these are some of the factors that we also consider when we provide the allocation, such that the additional allocations to be recommended will always be part of the budget process. That's why we say some of these recommendations will always be part of the future budget processes. I think that's all the questions that I had to deal with. Thanks. Back to you, Chair.
Apologies, Chair. We still have two other colleagues. Okhala Letseng will respond on local government, and I will come in to close out on economic policy. Thank you.
Okay.
Good afternoon, Chair and members and colleagues. My name is Okhala Letseng. It's not Letse Papakis, but I'm using his laptop. Just to answer two questions, one on the public employment programs in the local government, just to confirm that the funding for employment programs for local government, whether it's CWP and the one for metros, funded in this budget that has been tabled, and so they'll continue in the current financial year. But I must just indicate that so currently, as I think has been presented by DG previously, that there's a review of active labor market programs within the systems, and the recommendations of that will determine the form of employment programs in the future. But it doesn't mean they're going to stop, but it just means that we're going to find a way of how we make them efficient. So on the question of the local government equitable share, so just to indicate that work is underway to review the local government fiscal framework, which will include obviously even the revenue that is collected by municipalities, and also to include the adequacy of equitable share and the effectiveness of conditional grants. And this process will be informed by the robust research that we're going to do and the broad consultation to ensure that any adjustments are evidence-based and responsive to the real needs of communities within municipalities. So therefore, even the inputs of all the stakeholders will be carefully considered as part of this comprehensive review. And it's also important to know that that increasing the local equitable share is closely linked to the overall growth of the economy and would require reallocation of resources from other spheres of government. And at this point, of course, all functions are important, because if, for example, we say we take from provinces, we'll have to determine how those in province are funded, because it's not about a sphere of government, but it's about the functions that are assigned to those spheres. So therefore, this consideration will be central to ongoing reviews, and the input will be considered. So just to indicate that also conditional grants have a targeted role within the fiscal system. They are not intended to be permanent funding mechanism and are not designed to carry the recurring cost and such as those associated with insourcing. So therefore, that insourcing should be part of the running the business running of the business of municipalities, because conditional grants really are for supporting the specific purpose rather than funding ongoing operational expenses. And this principle will guide our approach as we review and strengthen the funding model for local government. And this work will also influence the finance chapter of the white paper that National Treasurer will be leading. Thank you, Chair.
Thank you, Chair. I will now take the last set of questions on growth more generally. I will start, with your permission, in response to questions related to Operation Vulindlela. We received a few questions in relation to Operation Vulindlela, effectively asking whether or not there have been tangible economic gains from it, and also more specifically from the AIDC related to how these gains have found expression, for instance, in our growth projections. So let me start by reiterating, Chair and honorable members, that the Operation Vulindlela Closeout Phase 1 report gives a sense of some of the progress actions that I had spoken to, including very tangible outcomes like the embedded generation pipeline in relation to renewable energy projects, all of which have implications for energy availability, economic activity, but also investment. So to answer that question more directly, you could see some of the progress in relation to reforms implementation in, for example, the gross fixed capital formation outlook that takes into consideration policy action from a renewables perspective through the IPP process, as well as to some extent embedded generation. Of course, there are even further upsides that could be realized from the embedded generation pipeline, but we tend to deal with those in our scenarios in response to some of the commentary that we've received regarding forecast accuracy to try and mitigate against over forecasting economic activity, despite us having some indication that this may be a credible upside risk to growth outlooks. So again, in brief, we capture the bulk, we capture some of the reform action in our baselines through key indicators like gross fixed capital formation, and we give some analysis of that, and some questions were asked in relation to that in the annexes to the presentation that we gave earlier today. And some of it we also capture in our scenarios, which would capture gains to growth in addition to what we expect to see or are capturing in our baselines. That would be the first. The second, which is a related question, is that Operation Vulindlela can't be taken in isolation or considered to be the full extent of the South African growth strategy, and this is exactly correct. Our view, as we presented in the presentation today, is that structural reform implementation is a part of a broader growth strategy, which includes macroeconomic stability, state capability, and investment in infrastructure. But even beyond this, to the very helpful reflections of Honorable Sokwate, the growth agenda is a combined government one, in which elements like industrial policy, trade policy, transport policy, spatial policy, etc., all work together to create the growth gains that are required to move us onto a higher and more sustainable growth trajectory. The framework we use, however, helps us to keep focused in terms of the priorities and how we are creating an enabling environment to secure the greatest gains to growth in the context of these complementary policies as well. So to answer the more conceptual growth, broader growth question of where is growth going to come from, it is going to come from the many sectors of the economy in which there is policy action that is driven through the various line departments in government, and ours is to ensure that we are creating the right environment for economic activity and ensuring that the fiscal framework balances the needs for economic activity while still ensuring that it meets the needs of the social wage in the context of some of the limited fiscal space that we have. So it is a story of trade-offs and finding the right balance for supporting economic activity, growth, and sustainability in a way that is inclusive and addresses the socioeconomic challenges. I would like to reflect on a few questions that Honorable Maoto had asked. I know Ravesh has dealt with some of them, but I would like to reflect on some of them as well. So I acknowledge the point made around fundamental differences in views on certain elements of our macro fiscal planning process, including on growth forecasts, which I think is fair for us to have different views. Our position is that our first best again for members' reference placed in the annexures our views and performance in relation to forecast errors to give a sense of the credibility and the reliability of the National Treasury's macroeconomic forecasts and their suitability for informing the macro fiscal planning process, which has reflected that they are fit for purpose and suitable for this function. Of course, as we've indicated in further submissions, there is always room for improvement, and we use both off-model work as well as the significant research publications that cover a great many work streams. And I'll reflect on this for a second, only because it has come up in different areas, both in relation to tax policy, fiscal policy, as well as growth policy, around how do we think about the evidence that supports our views. Many of those papers, more than 200 to be precise, are publicly available on the SA Tide website and can be engaged with across many of these work streams, just to close out that indication. So despite the fact that we've got differences in views on some of these elements of the macro fiscal strategy, our position is informed by this evidence, and we use it and rely on it to build the macro fiscal framework. Some direct questions that were asked is, one, do we agree or view that state-owned companies have a role to play in industrialization? Without doubt we do, which is why so much policy action has been focused on network industries, which are key facilitators of economic activity. Many of those network industries have state-owned enterprises as critical components of them. And to clarify, from an Operation Bolendlela perspective, there hasn't been a view towards privatization. There's been a view towards private sector participation, which in our view is necessary and important in the context of the very useful points that Dr. Mohammed from the PBO made around market concentration and market structure to ensure that we've got more competition, which allows for more dynamism in our economy and in the way that the economy is able to function and subsequently boost our competitiveness as a country and an economy. There was a question on economic stimulus, which I think has been answered by Mr. Dlamini. And just to reiterate that the technical evidence and backing for our view on the structural growth problem and the subsequent outcomes in respect to fiscal multipliers is also available publicly on these websites, on the SA Tide website. It's published there and informs some of our thinking regarding some of these issues. So I think that has been covered. And I'd just like to make sure that I haven't left out anything in this regard. I think that covers all of the questions that were posed on the growth perspective. So I think that covers us. Thank you so much, Chair. Over to you.
Thanks very much, Mawipuso and the team. Let me, before I adjourn the meeting, I want to check with honorable members if there are any member who will also want to say something, just for 1 minute. I don't see any. Can I allow Dr. Masangani, Honorable Van Rijn?
All right, thank you very much for the opportunity once more, Chair. Chair, earlier on I forgot to indicate that one of our own, Honorable Molefe, was conferred with his Masters of Law qualification yesterday. So I want to take this opportunity to convey our congratulations on this important achievement. Thank you very much.
Thanks very much, Honorable Van Rijn. Yes, indeed, congratulations to Mr. Honorable Van Rijn. Can I allow Dr. Masangani? Dr. Masangani?
Thank you, Chairperson, Honorable Ndlovu, to the colleagues, stakeholders, and our support teams and the media. Let me say that I think, Chairperson, there is an issue that is being raised consistently, which I think we have to attend to seriously. So, is the matter of public participation and how we consult the public in terms of decision making, be it on a policy or legislation. This matter has been raised several times, and probably we might have to find space, call the legal team, PBO, to take us through on this issue so that we don't take it for granted. On many cases, Parliament and the executive have been taken to court on the issue of public participation. You'll remember there was an issue about legislation on Traditional and Cohesion Act and other acts that were there. And this issue was central. So I don't think we should take it for granted that we have a full grasp of what public participation is all about. So that whatever decisions that we take, both as a Parliament and as the executive, we are quite sure that we are not ticking the box
public is quite involved, and we must take their input into consideration when we make decisions at the end of the day. The issue of the tax is not a matter that we'll run away from, because if taxpayers are raising issues, we have to listen very carefully as to what is it that they are complaining about and what are their inputs. We should not think that we have got a superior knowledge about taxation or the tax regime. It will be wrong. Those who are affected by the tax, who are taxpayers, we should listen to them very carefully because it comes time and again. Be that as it may, as we have said in the past, we should not also inculcate a culture of rebellion that every time the state talks about adjusting the tax, we want the public to rebel against the state. That will not be right. So we have to strike a balance, because at the end, there will be no state without taxation. Also, we can't always blame Treasury about the economic growth. We are the decision makers as members of Parliament. We have been elected on the 29th of May, 2024, to represent the people of South Africa in this Parliament. So the people of South Africa expect us, who carry their mandate, to take decisions on key issues. The issues that have been raised by Honorable Squati and others on the economic growth. Let's create space to discuss the economic trajectory of the country as collective in this platform that we have as members of Select and Standing Committee. Like we have done with the finance sector, we can create space for the economic trajectory as to which direction should the economy of South Africa take. Because it's of no use to keep on blaming other countries and the geopolitics. Yes, we are part of the global village, but we can't always be carrying hands on our heads, crying about somebody across the Atlantic. We are here. We have to discuss this matter. It affects the youth. Graduate unemployment is growing. It's at 11% by now. We can't afford to take students to universities, TVET, and we don't absorb them in the economy. And we think that all the answers will come from Treasury. The answers, I think, should come from us who have been elected. Government is an instrument through which it must implement the decisions that come from the decision makers who are parliamentarians. And this also, Chairperson, applies to the issue of the budget. I hear members complaining that Treasury is not taking our inputs serious. The stakeholders here are not making inputs to Treasury. They are making inputs to Parliament. Hence, we are calling on Treasury to respond. It is Parliament at the end that must take decisions, because the budget at the end becomes an act of Parliament. So in this regard, it is us who must decide as to what do we want on issues that have been raised by public. Treasury has presented the budget accompanied by SARS, but us, we must decide what should be contained in the fiscal framework, in the appropriation bill, as well as in the division of revenue bill that will become an act of Parliament later. I think that should be emphasized, Chairperson, that on issues of budget, it's not Treasury, which is a decision maker. It is Parliament. Parliament meaning NA and the NCOP. And we must reassert that authority as members of Parliament. So I thought, Chairperson, that we should emphasize these issues. And at some stage, we have to find a way as to where is the intersection between the public participation model of the executive and that of Parliament. Because I have got a model adopted by Parliament and the legislative sector on a public participation model. But does it interface properly with what is there in executive? So that from time to time, we don't rely on the courts to tell us as to how we must consult the public, how we must engage people on law and policy making. We must do things properly as these two arms of government. Be that as it may, thanks very much. And I heard, Chairperson, that there are DDGs that have been promoted. I think there are three. I can't remember their names. But I think it's up to you. Please congratulate them as our colleagues, and as Honorable Van Rooyen has informed us that our colleague Honorable Mlife has graduated with LLM. Congratulations to Honorable Mlife for that academic achievement. Thanks very much, Chairperson.
Thank you, Chair.
Oh, can't you honor more platform? Congratulations.
Thank you. No, we are position. I agree with you fully that we must give the policy direction.
Really well, congratulations again.
Thanks very much, Dr. Masangani, for the mini workshops, and I also want to join Honorable Molefe also in also thanking you for that mini workshops. At least we'll have an understanding going forward on what we need to do and what should happen, especially to also look at our own responsibilities as the parliamentarians being elected on the day on the 29th of May. Honorable members, to yourself, Dr. Masangani, co-chair, honorable members, representations from National Treasury and SARS, and also our stakeholders. Thanks very much. As we conclude today's session, I would like to express my sincere appreciation to the National Treasury and SARS for their comprehensive responses to the submissions made during the public hearing. Your detailed engagement today has provided much needed clarity and demonstrated a commitment to addressing the concerns raised by stakeholders. And I must also again congratulate Honorable Molefe for the efforts that he has made to us, especially showing it that it is indeed education is the key to success. So we are saying congratulations, Honorable Molefe, and the promotion to the team from the National Treasury, DDG. I thought the Osbu Puzo will also inform us. We don't also remember the names, Dr. Masangai, of the officials who has been promoted, but we also want to congratulate them for being able to being promoted on the National Treasury. So thanks very much, and we also want to congratulate you. In conclusion, honorable members, thanks very much, and by so saying, our meeting adjourned. Thanks very much.
Thank you.
Maybe before that, sorry, before that,
Malibongwe.
honorable members, before that, there is an announcement. I think Ndate Mangweng, with your team, and can you also just go through, take us to the announcement, and as we also congratulate you for making sure that our meeting becomes a success and preparation for today's meeting. Can I give you the opportunity, Ndate Mangweng, for the announcement?
Thanks, Chairperson. The first one is just to remind stakeholders to continue sending their summaries until at least by the end of business today. The second one is just to remind members about next week's meeting for the consideration of the report. That will be Tuesday and possibly Wednesday. Thanks, Chair.
Okay. Thanks very much, honorable members. The meeting agenda. Thank you.
Chair.
Thank you. Bye-bye.
Thank you. Bye.
Thank you, Chair.
Malibongwe.
Chair.
Thanks, Chair.
But Chair, I
Goodbye.
wanted to
Thank
say
you.
something. I've been
Thank
here.
you.
I wanted to say, please accept my apology for next week, Tuesday. I'll be in court fighting the fuel increase. Going to reverse it.
Monday.
Okay, Tuesday.
Oh.
Okay.
Yeah.
I'm coming back with that. It's
Yeah, get TG. What's over rata court? I can say what I'm at the Banyano. But we won. Bye bye.
No, I court.
Good luck. Good luck.